We've been concerned about inflation for a while.
We're getting what we expected on inflation.
You are seeing more evidence of a softening in labor market conditions.
The economy is gradually grinding to a halt here.
The economy is set to reaccelerate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, looking for another week of gains as the S&P 500 puts together a 4-day winning streak. More soft labour market data is keeping the Fed on course to cut. And Treasury Secretary Scott Bessent is preparing to lay the groundwork for a Trump-Xi summit.
Do these guys ever sleep? That's all I can say, because through the weekend, they're going to be overseas in Europe trying to create some sort of groundwork for late October, a Xi-Trump summit in China. And my question is, do we have a better sense of what the ultimate goal is here? What is the relationship between the U.S. and China that we're looking at a time of incredible confusion, given Russia, secondary sanctions, Mexico putting tariffs up, and how much we can get a sense of what the ultimate goal here really is?
Well, we're going to a weekend when trade risk now is once again kind of top of the agenda. You mentioned Mexico, China coming out with a statement saying the U.S. has abused tariffs around the world, and that has sparked widespread global opposition. At the same time, the Treasury Secretary is about to sit down with He Lifeng. So you could see there is this sort of trade angst still percolating, at least in the geopolitical space. For a lot of these third countries like Mexico, they might have to choose between Washington and Beijing.
It's setting us up for a big week next week, not just on the trade front, but on monetary policy as well. Next week, it's not about cuts. It's about guidance. Is this going to be a mid-cycle adjustment or a full easing cycle?
Yeah, and does it really matter what the guidance is, given that we don't know what the composition of the Fed is going to be early next year? Right now, the market is betting that the Fed will be able to cut possibly 3 times this year and do so credibly. Michael Hartnett saying that this market is betting the Fed can stay ahead of the curve and cut into a reacceleration. Sort of this Goldilocks 5.0, wherever we are in terms of Goldilocks. And I just wonder how much the Fed can support that, or is the Fed coming out and confirming that almost a risk event because it's all been priced in?
I think we've got to talk about this bond market. Really interesting development taking place over the last, let's say, 2 weeks. Through August, this curve steepened, led by the front end. Through September, this curve is flattening, led by the long end. That's a new development.
So there are 2 ways to interpret this. One is that it's actually acting as a safe haven trade. Once again, as people worry about the labor market and say longer term, maybe the trajectory isn't as positive. The second theory here is actually more interesting. It's that this administration really wants to get the long end of the yield curve down below 4%, possibly at 3%. That is that perfect 3% goal that Scott Bessent has put out there. And they could be creative with how the Treasury and the Fed work together. And that is increasingly coming into this idea. Maybe this trade's gone a little too far given that type of potential surprise on the horizon.
The 10's around 4% so far this morning. 30s. Remember being on 5%. Watch for 30s back down to 4.65. Coming up this hour, John Stolfus of Oppenheimer with stocks of fresh all-time highs. Ed Mills of Raymond James on new talks between the US and China. And Andrew Honhorst of Citi as the Fed gets the all clear to cut rates next week. We begin this hour with stocks steady after another rally to record highs. John Stolfus of Oppenheimer, the biggest bull on Wall Street, writing the following. We do not expect any dramatic cuts from the Fed, but rather measured trims. John joins us now for more. John, good morning.
Good morning,
Love
John.
that, don't you? Biggest bull on Wall Street. It's how I said good morning to you when I first saw you this morning. All-time highs on the S&P,
Yeah.
record highs on the NASDAQ, not too far away on small caps. Are trimmed cuts enough?
I think trim cuts will be enough. And I think the wonderful thing about trim cuts is for the Fed, what it is the economic data, particularly around the jobs number, has offered an opportunity of essentially a free haul pass. So if the Fed chair and the FOMC committee come out with a cut, it's not politics. It's just the dual mandate and looking at what the weakness in the jobs market and adding some liquidity to the system. And it's also an anniversary shot in September. If they do 25 bips or if they do even 50, the market should be able to take it, digest it.
Let's address that weakness in the jobs market. Are we testing the limits of bad news being good news for stocks?
I think somewhere in the middle of that, John. It depends the way traders look at it and the way intermediate to longer term investors who are investing for retirement, which is a multi-generational effort now, that has changed the tone of the private investor and the size and presence of the individual private investor more than I've ever seen it in 42 years.
At this point, we're watching what the Fed signals next week and how that really will play forward. And John was talking about, he didn't say these words because he hates these words, but a hawkish cut or a dovish cut. And there's this question going forward. If they are more...
I alluded to it.
You alluded to it because you tried not to say it, which I admire. And you did that very well, but I, of course, am going to violate that. I guess I'm curious if they are dovish, if they do indicate that this is something more than a mid-cycle adjustment. Does that make you more bearish?
Well, would that make me become bearish? Because I'm not bearish.
No, I know
bullish,
you're the biggest bull. Okay, yeah.
Okay.
Would it make you a little less bullish?
Yeah. It would certainly make me take a look at the data, see where we're going, and take a look at what the terms were that when the Fed chair is reporting to the press. How things went and answering questions. But overall, what we've seen really over the last couple of years has been the size of the U.S. economy and the resilience that exhibited both by corporations and by the consumer. I mean, the consumer, the soft data is, they're so worried about inflation, yet the consumer's still spending, and different things, but and also prudently. In this day of digitalization and information going around the world fairly quickly, it really is remarkable. When you look at the U.S. economy, around 30 trillion in size, still way ahead of China after all these years of us hearing that China was going to surpass us and everything else. It hasn't happened. And we think a lot of that is related to innovation. The Federal Reserve has done its job, we think, remarkably well. Once they got out from being behind the curve in March of 2022, so far with all the hikes, all the pauses, and very few cuts, no recession. Remarkable.
A lot of people who are listening to you are probably nodding along with this idea of innovation, especially when it comes to technology and how much that's powered what we've seen in the U.S. equity markets. Can that continue powering it, given how inflated expectations are and how difficult it is to price in a sea change in technology, innovation at the scale that, say, Oracle is predicting?
Well, I would say I think what type of overvaluation is being placed by investment or capex at this point really is in the eyes and the ears of the beholder. Because maybe the investments that are being made across the 11 sectors to participate in what AI can do, both for the consumer as well as for businesses, this may be appropriate, what we're seeing. This is so different than I remember the tech bubble, I'm like Father Time, 42 years in the business. Good Lord, it's shocking, I still feel 35, but it's like nearly 100, at this point. And when I look at it, it's just, this is not beginner's technology. This is, if anything, is technology that has to be checked somewhat by regulation, necessary, but not by too much regulation. And yet what it offers in a world in which we have not reproduced enough to replace ourselves, AI may be able to fill things out in factories and in offices where there might be shortages of employees. I do think, in case you think I'm just being too bullish or too positive.
No, I love it. Carry on.
I would say what does concern me is when we look at the current environment is moving forward. The first tranche beyond what we see in technology of layoffs will be a shock to the system and will cause a lot of questions as to how we're going to deal with it. But I think it's an opportunity for corporations to step up and train personnel, really position ourselves for what is genuinely a new economy that we are moving towards based on innovation.
John, that's what I wanted to ask you. To accept this innovation, do we need to accept that we're just going to have bigger layoffs and less jobs in the economy?
Well, I think I think that's the first part, that it gets. I think we need to prepare for that. And I think already we've heard Elon Musk and others mention the things that may be necessary to be considered. It really, if we meet it with retraining, looking for opportunities, because the biggest thing is, as wonderful as the machines can be, people love to deal with human beings. They just do, or not always love to deal with. I know that. Okay, let's not know. But at the same time, just
Speak
think
for yourself,
if you're trying to get some customer service, it's rare that you find an outfit that has real good beginners AI in those chat boxes and things to settle things.
When you mentioned the consumer as well, yesterday we did see household furnishings becoming a bit more expensive, clothing, airfares are up. Are you concerned about more of a tariff pass-through as we progress throughout 2025?
I think most certainly in the near term, and then I think as we go forward, if we see the benefits that the administration expects from it in reducing our deficits, I think that would be it would be very much helpful. And I also think, in addition to that, what we haven't seen yet across the sectors in a broad format is the reintroduction of competition. And usually, you know, my generation went through hyperinflation relative for the U.S. Back in the late 70s, early 80s. And it took years to get rid of that inflation. Its stickiness in inflation, the institutional memory is relatively short. But for the humans that went through it, gosh, it takes a while. But eventually you find people go, hey, wait a minute. If I give up what I'm charging on a per unit price and do volume, I can really get ahead of my competition, my competitors. When that begins, and it'll start, we've seen a little bit of it earlier this year in the airlines, but now it's going the other way, and it's demand is what's doing that.
What you said about AI, I think, is so important. What you're acknowledging is that it's going to be regressive up front. This is something that Luke Carr, our former colleague, has talked about extensively, and something Lisa's hammered home on again and again and again over the last month or so, is that we could see a real decoupling between the performance of the stock market and the direction of the labour market. Is that what you think people are comfortable with going into 26?
Oh, you know, at least at this point, I don't think that the market is looking as much to 26 yet as to the end of this year. I really think. I think when we start looking at it in 26, it'll probably bring up a bit, somewhat periods of volatility. When we see catalysts in terms of news items and things they'll make traders, skeptics, and bears, give them an opportunity to take profits without FOMO, and what likely is a secular bull market based on the degree of innovation we have today.
John, it's good to see you. 7,100, right? 7,100.
7,100. We're sticking with it right now.
Biggest bull on Wall Street. John Stolfus there of Oppenheimer. John, thank you, sir. It's good to see you. Thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahira for more. Hey, Yahira.
Hi, John. A manhunt is ongoing for the shooter who killed Charlie Kirk this week. The FBI released a surveillance video of the suspect dressed in black and seen darting across a rooftop, swinging over the edge, and walking past a parking lot at Utah Valley University. You can see it there. Utah Governor Spencer Cook says the state will pursue the death penalty against Kirk's killer. Meanwhile, President Donald Trump has asked a federal appeals court to pause a lower court decision blocking his ouster of Fed Governor Lisa Cook. The request for a stay or order would likely allow the firing to take effect before the appeal is formally heard. The administration wants a ruling by Monday, which is the day before the Fed's policy meeting. And shares of Warner Brothers Discovery are surging 5.6% in the pre-market following reports that Paramount Skydance is preparing a bid for the company. Sources say Warner Brothers CEO David Zaslav believes he can get a hefty premium for his streaming and studios business once they're separated from the cable business. The Paramount offer is being backed by the Ellison family. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes time. Plus, we'll get to that story too. I want to talk about this as well. RH CEO Gary Friedman, you see this story over at Restoration Hardware? Maybe my new favorite CEO just in terms of communication.
Yeah, going forward, just very blunt. And this is something that we're going to keep hearing. To me, I think that, honestly, CEOs are going to get rewarded for their bluntness.
Unless you want to go effing bankrupt, excuse my language, direct quote, in a market like this, you know, and stand there and be righteous and say, and I'm not promoting, good luck to you. Described it as the third year of the worst housing market I've seen in my 38 years in the industry.
Well, at least he's being honest. And ultimately, he's not alone. We're hearing that from a lot of different potential home builders. And frankly, this has been one of the big criticisms of this economy.
We'll come back to that story too later this morning. Big mover overnight. Equity futures down by about 0.1%. Up next, tough talks with China.
Obviously, our largest trade deficit is with China, and China does not have the same profit objective that other Western democracies do. My view has been that they would continue to eat the tariffs.
Up next, Ed Mills of Raymond James, live from New York City this morning. Good morning. Coming into Friday on a 4-day winning run on the S&P 500, the longest daily winning streak going back to July, record highs as we head into the weekend. Equity futures this morning pulling back just a little bit. We're down by 0.1% on the S&P, just about unchanged on the Nasdaq 100. Under surveillance this morning, tough talks with China.
Obviously, our largest trade deficit is with China, and China does not have the same profit objective that other Western democracies do. So that is an employment agency, and my view has been that they would continue to eat the tariffs. They are doing that. So I think what we've seen is likely to continue happening.
So here's the latest this morning. The US Treasury Secretary Scott Bessent preparing for fresh talks with Chinese leadership. The two sides meeting in Madrid next week, expecting to lay the groundwork for a Trump-Xi summit.
And there's been a series of meetings this week alone. We had the inaugural meeting between Defense Secretary Pete Hegseth and his counterpart, Marco Rubio, got on the phone with Wang Yi. So all of this potentially is building up to a bigger leader-to-leader summit. This could come on the sidelines at APEC if both these leaders are set to attend. Likely that can happen. Will they have a summit there? Potentially, you could see the President of the United States making it a little bit bigger, making a splash, going to, say, Beijing. What I find interesting about this meeting is two deadlines to watch. September 17th, TikTok just keeps being pushed back. That is on the table for He Lifeng and Secretary Bessent, as well as the fact that the trade truce, that ends in November. So there's a lot of issues that these two countries need to work out.
What stuck out for me? Madrid. Madrid's an odd choice for these talks to take place.
It's very odd given the fact that you have a leader in Spain that has really been kowtowing to Beijing.
And pushed back against the White House.
Pushing back against the White House, saying that they are the ones that are basically defending Europe in the face of the United States by what? Becoming closer to China? I'm just going to look at it as they've already done Switzerland, they've done London. Maybe they just wanted to, go to Southern Europe. Maybe Italy would have been a better choice.
Maybe Madrid is the Beijing of Europe.
Okay, Eric Adams.
Does sound like an Adams thing.
No, I'm just saying, maybe this is sort of like neutral ground because it has sort of an appeal to both sides.
The Treasury Secretary is also going to be meeting with Spanish counterparts. Maybe this is his chance to explain what the Chinese are actually doing, which is dumping on their markets and will actually kill their industries like we've seen them do when it comes to the German manufacturing base and what we see them doing in Mexico.
I think the Spanish government might be happy with that comparison, by the way.
That might actually work politically. Well, let's move on.
Ed Mills of Raymond James has this to say. The relationship is being carefully managed. We expect both countries to continue to extend 90-day tariff truces. Ed joins us now for more. Ed, welcome to the programme, sir. So we're setting the stage maybe for a summit between the two leaders. Where do you think there is perhaps a topic that's just proving very, very difficult to find a breakthrough on?
Well, I go back to the first thing that Donald Trump wanted to talk about with China, and it is on fentanyl. It is on kind of trade tariff barriers generally. I do believe that the president believes what the Treasury Secretary said, that when Trump puts tariffs on China, they will subsidize a lot of that cost. We go back to the first administration. We have the phase one trade deal that was never really implemented. President Trump did start off this conversation with saying before they can sit down, they wanted to see progress on implementing what he signed back in 2020. We haven't seen that. I do think the real reason we are meeting is because China was much more forceful in their response this time, where they stopped sending rare earth minerals. We couldn't make a magnet. We were really close to shutting down a lot of industrial production here in this country. That was an economic emergency that I think has been really underreported. And we got those back on. And Trump has sent a message to everyone in his administration: find a way to get me a meeting. And he thinks he can get into a room with Xi and cut a deal. The problem with that is that Xi does not like to go into a room unless it's 98, 90%, 99% set. And so we could have a personality clash come November once they do sit down.
Ahead of that potential meeting, do we have a sense of what the framework of any type of deal might look like, of what the ultimate goal is of both the United States and of China?
Yeah, Lisa, it's a good question. I would probably look at the other trade deals that we've been working on. They are kind of memorandums of understanding. I don't think we're going to have a deal completely fleshed out. I do think the goal is trying to not escalate things so that we can continue to get what we need from China. We will go into those meetings with a list of things that we would restrict to China if they continue to push back against kind of our demands. We also want to make sure that China is not an impediment to peace between Russia and Ukraine. I do think that we can't overlook the fact that we have not put secondary sanctions on China for their purchase of Russian energy because we are concerned if we do, that could break down those talks as well.
Well, that's exactly where I wanted to go. This question around the U.S. response to Russia and a question about when the U.S. will place secondary sanctions on China, on India. How much is this potential trade talk an obstacle to actual harder action against Russia right now, since that complicates it dramatically?
Yeah, so I think when I've talked to clients at Raymond James, we have a deal that we thought we were going to have with India. And because the administration couldn't get that deal and they're annoyed with India, they keep on increasing the kind of rhetoric and the sanctions and the secondary kind of tariffs on India because they don't have a trade deal. Because they want a trade deal with China and they are concerned that that could blow it up, they are not going to be putting these secondary sanctions on China as long as they think they can get a deal. And I do think it's also really interesting that Trump is not going directly towards China. He's trying to get others. They're like, all right, EU, put on 100% tariff on these goods with China. And I've always gone back to the fact that probably what our number one ask with the EU trade deal is choose a side. Is it the United States or China? They want us to make sure that they choose the United States within the EU, and things like the automobile industry, manufacturing. Don't have those joint ventures with China, have those joint ventures with the United States. So we're actually, instead of ramping up pressure on China directly, we're going to all of our allies and asking them to do the dirty work.
Ed, who has the leverage right now, Beijing or Washington?
I think it depends on the issue. I do think that President Xi has a lot of pressure on him. There's a lot of questions about the Chinese economy. There are a lot of things that the United States has that China needs. However, China had moved first in the leverage that they put on us. And so in the first round here in Trump 2.0, China did have additional leverage that I think came as surprise to the Trump administration, which has caused them to kind of reorient and try to get this Trump-Xi summit. Xi will not come to the United States to do this. Donald Trump, I do think your reporting is absolutely correct, Annmarie, doing it on the sidelines of the APEC summit or that big splash going to China on the way to the APEC summit in South Korea is probably what they have in mind.
But Ed, just in the past few minutes, you mentioned a number of issues: fentanyl, what's going on in Iran, Russia, China dumping on other markets. What is China's number one ask of the United States?
I think that their number one ask is to somewhat stand down and kind of make sure that we probably don't implement a lot of what we've done. And I think what we have seen is in these conversations, when we say, we want you to buy more, China says, well, there's one thing that we really want to buy. It's semiconductors and it's semi-cap equipment. And that is part of the reason why Trump has already allowed for the licensing of NVIDIA and AMD chips that he previously blocked. I don't think that they're going to be able to kind of expand some of those kind of relief on those restrictions to other semiconductors. But if there is one thing that China really does want, it's our technology.
Will he get it? Ed Mills of Raymond James. Ed, thank you, sir. Will Jensen Huang succeed in pushing the U.S. government to agree?
It's pretty fascinating that Jensen Huang is with President Trump in this visit overseas, over to Europe. So is Sam Altman. So you start wondering how much of a carrot and a stick the tech companies are. They're right alongside him with all of these negotiations.
And they're going to be pushing pretty hard for next week and well into next year and beyond. Up next on the programme, Robert Fishman of Moffett-Nathanson joins us on a potential media mega deal. Plus, we'll touch base with Danny. She's got your morning movers and some fiery commentary from the CEO of Restoration Hardware. RH is down in the pre-market by almost 10%. The broader market is doing okay. Equity futures down by about 1/10%, just pulling back from all-time highs on the S&P 500. Record highs on the S&P, record highs on the Nasdaq. From New York City, you're watching Bloomberg TV. Equities negative this morning, but positive on the week. We're down by about 1/10% so far on the S&P, but heading towards another week of gains on the S&P and on the Nasdaq. On the Russell, small caps are positive for a 6th consecutive week. as we look to close out the trading week this Friday. Equity futures, Russell 2000 futures negative by 0.5. Let's get you some movers going into the open. About 3 hours away. Here's Danny Berger with more. Hey, Danny.
Hey, John. A couple things working in Microsoft's favor early this morning. Shares are up 1.4%. First, you had the OpenAI decision to make them look more like a for-profit company. They'd had some really painful negotiations with Microsoft, so helps them keep that partnership. And also elsewhere, Microsoft avoiding a very hefty penalty from the EU around their Teams products, choosing instead to settle with authorities there. Elsewhere, it is another day, at least it is on track to be, of a rally for Warner Brothers, up 6 1/3% after yesterday, clocking its best single-day gain on record. This off the heels of Paramount Skydance looking at a bid for Warner Bros. Discovery. It would be backed by the Ellison family and looking at taking the whole thing. This is a company that had been looking at breaking up. Does this change its fortune? Finally, in furniture, R8 shares getting pummeled in the pre-market, down nearly 10%. They cut their outlook for the year, cited $30 million worth of a tariff hit. Maybe more interesting, though, the CEO on the earnings call talking about how this is an industry in turmoil that needs to have heavy discounts in order to lure shoppers in because of the housing markets. I won't repeat exactly what he said because it would literally get me fired, but it was something along the lines of, unless you want to go effing bankrupt, you need to discount your furniture sales. John?
I think direct quotes are okay. We would have excused that. Danny, thank you. Thank you very much. No pricing power. Home builders have rallied aggressively. They've taken off. And you've got a furniture provider turning around and telling you that things are absolutely terrible and we've got no pricing power.
This is also a CEO who came out pretty vociferously against the tariffs. You do wonder exactly what he is speaking to, and you wonder whether this is consistent throughout the industry. At the same time, I also wonder if it's clearing some of the inventory before whatever is to come next year. That said, pricing power, the lack therein, highlights the reason we haven't seen any kind of runaway inflation.
Stock is down by about 10% so far this morning. On our radar this morning, one of our top stories, the manhunt continues. Authorities are still searching for the killer of conservative activist Charlie Kirk, who was fatally shot Wednesday at a Utah university. The FBI releasing new footage of a person of interest fleeing the scene. Elsewhere, a trade war warning from China. The Ministry of Commerce urging Mexico to, quote, exercise extreme caution and think twice before imposing new tariffs on Chinese goods. Mexico announcing plans to impose duties of as much as 50% on cars and other products made by China. And finally, the race for the next Fed chair is heating up. According to reports, Treasury Secretary Scott Bessent is meeting with new candidates to replace Fed Chair Jay Powell. In recent days, he met with former Fed officials, including Larry Lindsey, Kevin Warsh, and Jim Bullard.
So these are all people who have been close to the Federal Reserve before, which is notable given the fact that we're currently talking about Stephen Myron, who hasn't been on the Fed, as potentially getting there as soon as Monday with a vote in Congress. It raises the question in my mind whether this is trying to create a lot of drama, but ultimately picking Chris Waller. And the reason why I say that is because essentially you're looking for someone that has credibility in markets, and you're looking for someone with that institutional knowledge of the Fed, not an outsider. That is notable to me, even as we pack on the names and create a process that sounds very dramatic.
Or James Bullard, his mentor, and then having two almost Bullard-Waller thinking types on the Federal Reserve. What I find interesting is I don't feel that there is this real urgency from the administration to want to get this shored up ASAP. And do you know why? Because the Fed is about to cut interest rates. It is moving in their direction. So they can sort of, Trump will come out and say too late because he feels vindicated. He feels I was able to feel the market. I was correct. Powell was behind. He was too late. We have seen that now, and it's going to be twice. But I don't get the sense that they're going to come out and immediately need to pick someone. So, the Treasury Secretary is even adding to the list, and he's going to have as many interviews as he wants.
I'll keep this brief. What struck me about this list, these three, is that two of them are really well known as being small balance sheet guys. They're not the kind of people that I think would be compatible with the kind of things that maybe the president would like to see in the next 4 years and beyond.
So is the speculation that Scott Bessent is trying to set up the field, game the field?
I don't know.
Or is it that Scott Bessent feels differently than other people and really is targeting 3% on that 10-year yield? This is the reason why people feel like whoever is going to be the next Fed chair will be creative with the balance sheet. Maybe not necessarily expand it, but creative, and work in tandem with the Treasury to help suppress some of those long-term yields.
I think Annmarie makes a really great point, though. You don't sense a great rush right now. No panic. They seem to be happy with this process just going forward slowly.
Yeah, and a scapegoat. I mean, ultimately, you have damned if you do, damned if you don't. Regardless of what happens in the economy, you can turn around and say, ooh, too late.
It's the Fed. It's Chairman Powell's fault. Let's turn to M&A. Isn't it always Chairman Powell's fault?
I mean, it's great.
It's always his fault. It's his fault. Paramount Skydance is preparing a bid to buy rival studio Warner Brothers Discovery. Sources telling us here at Bloomberg the offer will reportedly be mostly cash for the entire company, including its cable networks and movie studio. Joining us now to discuss is Geetha Raghunathan of Bloomberg Intelligence. Geetha, welcome to the programme. Let's just talk about what's happening here. This was a company that was about to split in two. Why is this solution better for shareholders?
Yeah, this is, the timing of this, John, I think is what is really throwing off a lot of investors. So we know that Warner Brothers Discovery had announced back in June a plan to separate out its secularly challenged TV networks from the studio and streaming business. This Paramount bid, and so always, I mean, the interest was going to be for, the crown jewels in the business, which is, the studio and the streaming portion. So just this Paramount bid kind of coming in. First of all, why it's better for investors is because it's going to be an all-cash bid. Most importantly, it has the backing of the Ellison family. I think that makes a huge difference. It's a bid that is going to include the cable networks, which, by the way, is not a desirable asset right now. And so the fact that, we have a taker for all of the assets, I think makes it definitely appealing.
Geetha, let's talk about some of the companies involved here. Paramount Plus getting together with HBO Max, CBS News together with, say, CNN. Are they great synergies or are they messy relationships?
Great synergies right now. I mean, we just have Paramount. What's really interesting here, John, is we just had Paramount, which freshly just combined with Skydance. And when we spoke about that deal, they were talking about $2 billion in synergies. You think about a company, the scale of Warner Brothers Discovery, all of the different assets that it has in its portfolio. You brought up the TV networks. We're thinking something like, $4 to $5 billion in synergies at the very least. I mean, there's just a whole lot of different cost efficiencies across the TV networks, across the studios that can be achieved here. So it makes a ton of strategic, a ton of economic sense.
Geetha Raghunathan of Bloomberg. Geetha, thank you. Appreciate it. Robert Fishman, senior research analyst at Moffett-Nathanson, is writing this. We view the news as a key milestone in the Warner Brothers Discovery success story and potentially the opening of a second chapter for a growing media conglomerate. Robert joins us now for more. Robert, welcome to the programme, sir. Let's just start with the basics. What's to like this morning with this potential tie-up?
Well, I think as you just heard, what you have is a lot of potential strategic combination between these two players. We've been talking for a long time about the lack of scale on streaming. And what this does is really help accelerate the streaming story by putting two subscale players together to help better compete in the current landscape. Then you also have to go to the cost savings that were just discussed. We're still working through our assumptions, but essentially, there will be a lot of extra cost synergies putting these portfolios together. And then really what this does for Warner Brothers Discovery is allow them to accelerate that timeline that you just talked about. And really for investors to see the payoff of how valuable these assets are, like HBO and Max and Warner Brothers Studios. So it really is a really strong evidence of the value in the Warner Brothers portfolio.
Once upon a time, the idea of CBS and CNN being combined and the idea of synergies, read probably job losses and some consolidation of efforts, would have raised concerns by regulators. Will it still, or has the landscape changed so much competitively that it doesn't necessarily reach that level?
That's a really interesting question. I would say that the landscape has clearly changed. Back to my first point, streaming is first and foremost here, and that's where all the eyeballs are going, and already, essentially are for a lot of the parts in the media business. On news specifically, yes, it does seem like the strategic combination of a CBS News with a CNN would be something that makes a lot of sense from a cost saving standpoint and strategically to put those two assets together.
How much do you think that Warner Brothers is going to hold off on any kind of deal because they were planning on splitting up and they did believe that each of the pieces was worth a lot more than the whole? We are seeing a premium here in terms of the Paramount Skydance offer from Ellison. But do you think that it's enough, or do you think that it's going to have to be sweetened?
Well, I think we're going to see how this all plays out. So this is just kind of the first salvo, and really what we're really waiting to see is if the Paramount Skydance bid is going to bring in other bidders here, because that potentially has the opportunity to, as we've seen in past, these are premium, very, very demanded assets, especially when you think about the studio and streaming and HBO. So if this is the opportunity for other companies to explore that's something that we're waiting to see if that's going to bring in other potential bidders here.
Potentially a price war. Who else could bid for these assets?
Well, I mean, if you go through the list, clearly Comcast is a potential bidder. It's unclear, to the regulatory point if they're going to look to enter into the fray and put their hat in the ring. But I think Comcast has long been discussed, again, from the streaming side and also from the studio side and other assets that this can be part of. The question is, they're going through their own spin with Versant, and essentially, do they want to change strategies as well? That's remains an open question. Obviously the digital big bidders are some ones that we all have to look at and see whether or not they want to really throw their hat in the ring, again, from the regulatory side, and even a company like Apple, if they really want to go all in on media.
How much more consolidation could we see, Robert, in this space?
Well, this is a big one. We've been waiting for something like this for a little while now. Again, talking about the potential dance partners with a Comcast, with Warner Brothers Discovery, and Paramount being the three key players. So, I think this is going to lead to other potential dominoes that could fall, but clearly this is the big one that we're all focused on right now.
Robert, appreciate your update and your take this morning. Thanks for making time for us. Robert Fishman there of MoffettNathanson, CBS together with CNN. Something we've been talking about since the late 90s, early 2000s, and here we are. And as you pointed out, and it's a perfect point, this is a very different environment compared to 25 years ago.
This would never have been allowed 25 years ago because there would have been thought to be something of an oligarchy when it came to disseminating news. Now people get their news in lots of different ways, and there are lots of different competitors. I just wonder whether this subjects this whole deal to less scrutiny, or whether it still will have the same kind of resonance, especially given some of the creative output and the demand for some of these properties.
Futures this morning down by about 0.1% on the S&P. If you are just joining us, welcome to the programme. Let's get you some news, some top stories worldwide with your Bloomberg brief. Here's Yahara with more. Hey, Yahara.
Hi, John. Brazil's former president Jair Bolsonaro has been sentenced to over 27 years in prison. He was convicted on charges he sought to cling to power by plotting a military coup that included plans to assassinate current President Luiz Inácio Lula da Silva. Bolsonaro's lawyers are expected to appeal his sentence. The U.S. has warned it will act accordingly to what it called a witch hunt. Meanwhile, the first full month of President Donald Trump's tariffs set a new all-time monthly record by bringing in nearly $30 billion. According to the latest monthly statement from the U.S. Treasury Department, net customs receipts for the fiscal year, which ends on September 30th, are at a record more than $165 billion. And President Donald Trump attended the New York Yankees game last night in the Bronx, speaking to members of the team, including Aaron Judge, ahead of their September 11th game against the Detroit Tigers. The Yankees came out on top 9-3, with Aaron Judge hitting 2 home runs, tying Joe DiMaggio for 4th on the franchise's all-time home runs list. That's your Bloomberg Brief. John?
Yahara, thank you. And guess who was in Yankee Stadium? Drum roll. I think you know the answer to that.
It was incredible. Not just Yankee Stadium. I'm wearing my Yankee jacket on Air Force One with the president.
What did the president say?
The president went into, behind the scenes, went and met the team, and he talked about 2 things I thought were really funny. One, Aaron Judge, guy couldn't be bigger. To make Donald Trump actually look not as tall as he is pretty astounding. Like, he's 6'7", the guy is huge. And then on top of that, he said they're going to go all the way. And I think Aaron Judge thinks he was a good luck charm. He's hit 2 home runs. So we might have to get the president at more Yankee games if we want to see them go into the World Series.
Very cool. Up next on the program, paving the way for rate cuts.
We're thinking of the inflation trajectory as more of a plateau rather than a mountain. It does look like the Fed will cut. We still think they'll have to be quite cautious in cutting, so we only have 2 cuts in this cycle under Chair Powell.
Up next, we'll catch up with Andrew Honhorst of Citi, live from New York. You're watching Bloomberg TV. Equities are negative this morning. We're down 0.1% on the S&P. Record highs coming into Friday on both the S&P 500 and NASDAQ 100. The NASDAQ just about unchanged. Under surveillance this morning, paving the way for rate cuts.
We've been concerned about inflation for a while. Not necessarily the impact of changes to trade policy, but just underlying inflation. We think that's been stuck around 2.5%. for a long time now. We're thinking of the inflation trajectory as more of a plateau rather than a mountain. It does look like the Fed will cut. We still think they'll have to be quite cautious in cutting, so we only have 2 cuts in this cycle under Chair Powell.
So here's the latest this morning. A busy week of economic data paving the way for the Fed to cut interest rates next week. Andrew Honhorst of Citi writing, we continue to expect 125 basis points of rate cuts over the next 5 FOMC meetings, with growing risk that the Fed will continue cutting interest rates below 3%. Andrew joins us now for more. Andrew, good morning.
Good morning.
Got to get to that 3% call in just a moment, but I want to address the data of the last 24 hours. So jobless claims came in close to 4-year highs, sparked a bit of concern. Then we got into the numbers and it screams one state, it screams Texas. Is there anything to be concerned about here at all?
Yeah, I mean, I think you always have to watch the jobless claims numbers. What we would look for is this going to be a sustained movement up in jobless claims? A lot of times you get 1 week of data, and it's weekly data, right? You're trying to seasonally adjust weekly data in a holiday week, spiked up in one state, so you never take that too seriously. So I'd be kind of cautious in terms of getting too concerned about that number.
The broader backdrop, though, the totality of the data, as the Fed likes to say, hasn't been great on the labour market side of things. When we go into next week, we're talking about the following: mid-cycle adjustment or the start of a really big easing cycle. And you've alluded to it. Are we going to stop at 3%, or will we need to go even further?
I think it's increasingly clear that we're going to get to at least 3%. And you look at the jobs data, and we do have some conflict in the data. If you look at the household survey where the unemployment rate comes from, unemployment rate has been more stable. It did move up in the last report. You look at the payrolls data, and with these revisions, it's just fallen apart. I mean, we're running at 29,000 jobs per month on a moving average basis, just 22,000 jobs last month. You look at the benchmark revisions and say, maybe we're overstating that payrolls number each month. So, subtract a little for that. We're probably close to zero job growth in terms of payrolls. So there's no question that you want to be moving rates at least back towards a more neutral setting. I think with the cooler inflation data that we're getting now, you can really start thinking about, do they actually move below 3%?
Well, hold on a second. The cooling inflation data, sure. We're still above 3% on a year-over-year basis. You still haven't gotten below 2% going back more than 4 years. Is that enough at this point to be actually a reason for the Fed to cut aggressively?
Well, I think the reason to cut aggressively is the jobs data, what we're seeing in the labor market. The question is, how constrained are you by inflation, to your point? And you're right, you look at core PCE inflation, we're still above 3%. When we looked at the CPI report yesterday, though, this is really interesting. You map that through to core PCE inflation, we're getting just 0.20% month-on-month core PCE inflation. So that's monthly annualized core inflation that's running pretty close to 2%. And that year-on-year figure may be going to come down to 2.9%. So we could get below 3% on a year-on-year basis. We're running close to 2% on a monthly basis. And remember, this is August inflation data. This was meant to be the peak of tariff pass-through and the high inflation that we were going to see. And we're close to target. So I think there's a lot less of a constraint on the inflation side. That's maybe more underappreciated by the market right now. I think everyone's acknowledging now that you have this risk on the labor market side. I'm pretty clear what the Fed's going to do here.
I mean, we've got the Restoration Hardware CEO cursing out the investors because of their inability to have pricing power. So it raises a question of further disinflation. There is a feeling, though, that going forward, there is going to be a reacceleration of the economy, thus the bet on small caps, thus the bet on equities. And how much do you see that as sort of predicated on the Fed cuts that you're talking about, that will ignite the reacceleration of growth that so many people are hinging their bets on?
There's a little bit of a disconnect between markets here, and I hear this when I speak with investors also, that equity market, I think, definitely thinks that there'll be this reacceleration in the economy. Not as clear to me that the rates market is sold on that, which is part of why we're pricing in these cuts in the rates market. So maybe you need to kind of reconcile those two markets with each other. I do think that these Fed cuts are getting increasingly priced in. I think that is part of the story of what is supposed to get the economy moving a little bit faster. Again, you look at the housing market, that's the most interest rate sensitive sector of the economy. And we have really weak housing right now in terms of activity, in terms of prices moving lower. You need to get rates lower if you want to reaccelerate that portion of the economy. The question, though, is the Fed cuts interest rates. It's going to bring down policy rates. It's going to bring down the 2-year yield. How much lower will we get in terms of the 10-year yield? It has been moving down together with the front end of the yield curve, but I think that's still an open question.
Andrew, how likely is it potentially that they go 50 basis points, especially given everything you've just outlined in the last 5 minutes?
So I think fundamentally you can look at this data and you can say, look back at June payrolls. June payrolls originally reported above 150,000. Now it's negative, right? If we had a negative payrolls print in June, I'm pretty sure this is a Fed that would have been cutting in July, right? We would have seen rate cuts by now. That said, there are big differences across the committee. Remember, back in June, we had a lot of Fed officials who didn't want to cut at all this year. Powell has to pull that committee together. So 25 basis points, I think, is going to be a lot easier to build a consensus around. We could see some dissents for 50. I wouldn't be surprised if we see some dissents, but 25 looks much, much more likely than 50.
What does a Fed under Lawrence Lindsay, Kevin Warsh, or James Bullard look like, given the fact that those are the most recent individuals to sit down with the Treasury Secretary?
Yeah, personnel matters here, right? There's no question that the Fed chair matters. It is a committee, right? So we always think about, where are the votes actually going to line up in terms of where policy rates go. One discussion, we're talking about 3%. Why does everyone talk about 3%? That's kind of a notion of where maybe the neutral policy rate is. Different candidates for Fed chair are going to have different views about where the neutral rate is. And I'm pretty sure when Treasury Secretary Bessent is interviewing these Fed officials, that's one of the discussions that they're having. So, where do you see neutral? How quickly do you think we need to get to neutral? That could depend on the Fed chair.
Where do you see neutral?
I think neutral is still around 3% here. So when we talk about the Fed cutting below 3%, that's really, are they going to actually go to stimulative levels? To Lisa's point, if you have an inflation problem, it gets pretty awkward to get below neutral. But if this inflation problem is, kind of quickly disappearing, which I think it may in the next few months of data, all of a sudden there's less of a constraint, and yeah, you should support the labor market.
Got about 60 seconds left. They don't forecast payrolls; they forecast unemployment, and they've got unemployment year-end at 4.5%, core PCE at 3.1. Is there anything that's evolved since the last meeting that's out of whack with the June SEP?
Those forecasts can actually pretty much stay where they are. And I think the way that Chair Powell will talk about this, and he said this at Jackson Hole, it's not where that point estimate is. So you might still be at 4.5% on the unemployment rate. What's the risk around that? We're running 29,000 payrolls. It's to the upside on the
But if he
starts
talking about risk management rate cuts, that's very different to the kind of rate cycle, cutting cycle that some people are thinking about in financial markets.
Yeah, the idea of a hawkish cut if he starts just talking about maintenance versus something that is more stimulative. How many jobs does this economy need to really be even? And frankly, how much has that number gone down as a result of fewer immigrants coming into the country?
Can this Fed meet the market? Something Neil Dutta of Renmac poured some freezing cold water on just yesterday. Andrew, it's good to see you. Thanks for dropping by. I appreciate it. Andrew Honhorst there of Citi. Up next, Steve Orth of Federated, George Pollack of Signum, Sheila Kaiolu of Jefferies, and Sam Zeef of JP Morgan Private Bank. The second hour of Bloomberg Surveillance just around the corner.
The animal spirits are back.
We think equities can continue to rally.
Stocks have been very conditioned to rate cuts.
The market's going to trade off the narrative that we have a dovish Fed.
Any sort of a pullback makes a big case for the markets to go up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, and your second hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P 500 negative by just 0.1%, following a 4-day winning streak on the S&P 500. On the Nasdaq 100, just about unchanged. In the bond market, the long end of the curve starting to outperform the front end of the curve. We've actually had what's called a bull flattener through September so far. That's a change, a different development. We'll get to that story later in the program as we set you up for next week and the last day of trading going into the weekend. Hugh Mitchell a little bit later on this morning. Look out for that at 10 a.m. Eastern Time as we work our way through next week. The main event has got to be Chairman Powell on Wednesday. Decision, forecast, news conference.
Yeah, and the sort of drum roll leading up to that as to who is going to be at that meeting on Tuesday that leads into Wednesday, considering the Stephen Myron hearing on Monday and this bid to get Lisa Cook off the Board of Governors before that Wednesday meeting. A key question to me is how they message, as you were mentioning, the tenor of the rate cuts. Right now, markets are pricing in 75 basis points of rate cuts this year and at least 2 more next year at a time when you still have inflation well above 2%, well above 3%. How do they really message this at a time of growing concern about the labor market?
To the personnel issue, it's going to be a bit awkward having Steve Myron, who still has one foot at CEA, working at the White House, joining the FOMC next week, most likely as long as he gets that Senate vote, alongside Governor Lisa Cook, who the judge is saying she can remain at the FOMC at this moment as the Trump administration appeals because they are saying that they have cause to get her off. So first off, the personnel is going to be, I think you would call it prime time. Second, when
box office.
Box office.
Pay-per-view.
Pay-per-view, box office.
Get it straight.
Okay, sorry. The second thing I would say is they're going to be meeting at a time when you still have trade negotiations ongoing and still concern for some what is going on with tariff rates. We're still waiting on the IEEPA decision, and you have the Treasury Secretary going to sit down with his Chinese counterpart.
I'm pleased you keep building on Stephen Myron. First thing I'm going to look for, that dot on the dot plot. Stephen Myron, like somewhere down here.
He wants to anchor.
26
yeah,
and
my
27.
favorite part is people say, is there going to be a descent for 50? Is there going to be a descent for 200, right? Basis points of cuts. And we'll know who that is.
Coming up on the program, Steve Author, Federated, as markets continue a record run. We'll catch up with George Pollack of Signum with the list of Fed chair candidates continuing to expand, and Sheila Kahlo of Jefferies as airfares take off. We begin this hour with stocks hitting record highs as Wall Street banks on the first Fed rate cut of the year. Steve Author, Federated, seeing the glass half full. He writes, it will be no surprise if they cut rates next week, finally reviving the interest rate sensitive areas of the economy still in recession. Steve joins us now for more. Steve, good morning.
Good morning.
Good to see you, my friend. Thanks for being here with us. The challenge for investors right now, and I think you and the team have addressed it quite well. The challenge is to carry on looking forward as the Fed is looking backwards. And that tension begins to build as they keep getting this data that says, you're late, get a move on. How are you going to manage that in the months to come?
We're going to keep doing what we've been doing, which is try to predict where the Fed is heading based on where we think the economy is heading, as opposed to compared to what they say they're doing. So we've got them. We've been of the view for some time now, as you know, that the Fed is going to cut because they can cut, not because they need to cut. The transmission mechanism for goods inflation is the labor market. The labor market has been softening, and there's key elements that are labor-intensive elements of the economy that are in recession. Small caps have been flat in earnings growth over the last 6 quarters. There's been an earnings recession in small companies. They depend on interest rates. Housing is in a recession. The auto sector is in tough shape. These sectors of the economy are the ones that are going to pick up when the Fed starts cutting. And we've said they can cut because they can cut. Now with the labor market clearly softening, there are concerns about tariff inflation, or one-off tariff increases, which we have calculated to be about 13% of the total pie, not the 18 that people talk about. We can talk about why that would be. But if you look at that and assume half of it is going to be picked up by the exporters from foreign countries, it's about a 75 basis point hit spread over maybe 12 months. So we're seeing a little bit of that now. We'll probably see a little bit more, but the core numbers are heading towards their target of 2.5. They say officially it's 2, but we think they shifted to 2.5 a long time ago. And so now with the transmission mechanism obviously broken, and they're going to cut, and we would guess a bullish cut. So or a dovish cut. So like a 25 basis point, but we're going to keep this going. They can go to 3. If you have an inflation rate of 2.5, you should be about 50 basis points above that to get to the kind of the normal short-term rate. You put 150 to 200 on top of the 2.5 for the 10-year. The yield curve, you get to around 4. We're there. And we think that's another driver for stocks in the next 12 months, along with the reacceleration that we're seeing.
Let's unpack some of those calls. So we're seeing a reacceleration in the equity market. We're not seeing it in the economy. This is the distinction to make at the moment. You mentioned small caps up for 6 weeks. Home builders have absolutely ripped. This is what Restoration Hardware is telling us this morning. The third year of the worst housing market I've seen in my 38 years in the history. How backward looking is all of that? How confident are you in the team that the worst of the data is in the rearview mirror?
Well, we're looking at a number of reaccelerants starting in the back half of this year, but particularly in 26. First of all the uncertainty about tariffs go off the table. So there's a sort of a psychological boost that's going to happen. Secondly, you've got big CapEx incentives in the bill that come into place, and there'll be we think a sort of a CapEx flush, both in the software sector. Our software analysts are seeing this coming in the fourth quarter on the software side, but more broadly across the economy as decisions can now be made about the future. That's what CapEx is. You've got the tax incentives to produce that. You've got the tax rebates coming in effect. It's going to be basically a check to every consumer because the tax cuts were retroactive to 1/1/25, but the IRS hasn't been able to fix their system. So all those withholding taxes on tips and all that thing, that's all going to get refunded early in the first quarter of 26. And then, of course, you have the Fed rate cuts, helping those sectors of the economy that are very rate sensitive. What people don't know that today, the U.S. economy is not as rate sensitive as it was. It just isn't, because the service sector is much less rate sensitive. But the sectors that are rate sensitive, they're going to be another kicker for the U.S. economy in 26.
The fact that those areas have been in recession and we still haven't gotten inflation below 3% raises questions about going forward, how much inflation could reaccelerate if those areas are turbocharged at the same time that everything else is being turbocharged.
Right. So coming out of the lockdown, right? The problem was labor was in very short supply. You saw it here in New York, stores all over the place. Help wanted, get it, help, help, help. Do you see any help wanted signs, right? The labor markets have more than stabilized. They've recovered. And now you're starting to see actually excess labor, and AI is adding to that. So the worker doesn't have the leverage to get pricing power on wages that he or she had 2 years ago. That transmission mechanism is over. So we're much more comfortable about, the inflation outlook because that transmission mechanism is cracked.
So do you reject that sort of voice that keeps coming in my head? Watch the gold market. Watch the gold market. It's telling you something. Are you just sort of saying it's not telling you anything? It's telling you that there's central bank buying and it has nothing to do with long-term inflation expectations.
Well, Lisa, I should make you my gold analyst then, because I
think you hear two different voices.
I spent 40 years in this business. I can't figure out gold. There's just too many. There's a real market for gold. People use it for jewelry and other real things. There's central banks operating with very long-term objectives. There's short-term players. There's a lot going on, and gold is what someone's willing to pay for it. I like to find things that can generate cash flows that I can predict and then discount back. I can't do that with gold. So I know you probably can make a lot of money in gold, but and other people have. It's just that we don't play in it.
But
we don't think we can do it well.
It's become a geopolitical hedge, though, for a lot of countries that don't want to hold dollars anymore. So doesn't that mean, the only direction of travel for gold really is going to be up?
I don't know. I mean, a lot of the gold, you ever been to the vaults of the New York Fed?
No, but I've heard about it.
A lot of gold down there.
Maybe you can take us. Field trip.
What happened to the tour of Fort Knox?
All these central banks store their gold in New York.
I think the administration thinks I'm a conspiracy theorist because I keep asking to go.
You still want the tour?
Yeah, I want the tour.
You still want the tour.
Yeah.
Steve, before you go, I wanted to ask you about valuations. Typically, if we just had a period of weaker than expected economic data and had a guest come on the program and talk to us about buying the recovery, most people would be comfortable with that if the forward multiple was closer to 16 than it is to 20. What kind of valuation do we need to get used to given the character of this equity market now?
We think 21.5, or 21 to 22. And the way we came to this about a year and a half ago, we said, well, wait a second here. Everyone's heuristics on what is a fair value for the market are based on history. Typically with a 3%, 2.5 to 3% inflation rate, you'd be at an 18 multiple on stocks. The problem is, or opportunity is, that in the stock market today, 40% of it are these giant cash flow generators that are growing at double-digit rates, and they're asset light. Those businesses are simply worth more on a PE basis than a big industrial company. So we've been valuing the market as two markets. So 40% at like 25 times earnings, not as high a multiple of cash flow, and then 18 on everything else. And when you work that out, we don't see this market as cheap here, but we see it as kind of at fair value.
Yeah, when you benchmark this, you've got to be careful about what you benchmark this against. Yeah. The market history might not be as helpful as it has been.
I love the idea of two different markets, the idea of the Magnificent Seven or the Magnificent Eight, if you want to stick Oracle in there, or however many you want to put in there. This idea that it is a paradigm shift, and they are leveraged to a paradigm shift where they have cash flows up the wazoo, and they don't have that many assets, and it really is a very different model.
Steve, do you want a final word? What's the price target now in the S&P?
Well, we haven't changed our year-end price target at 6,500. I just don't like making 3-month forecasts on equities. I think we're overdue for a correction, so we'll see. But we've been saying a correction be more of a broadening out rotation, kind of chopping around this level than a big move forward. We've got 7,500 for next year. We set that about 8 months ago, and that's we're sticking with that. We think there's good upside here. We don't think it's a screamer, but there's certainly good upside. We're still overweight stocks here, and particularly we're overweight the broadening out trade. So we like the small caps, EM, emerging markets, value stocks, regional banks look good to us.
For as long as I've known you, you've been bullish and right. It's good to see you, sir. Appreciate it.
Thank you.
Thank you. Steve Author of Federated Hermes. If you're just joining us, equities negative by only 0.1% on the S&P, coming off the back of a 4-day winning streak and closing at all-time highs in Thursday's session. With an update on stories worldwide with your Bloomberg Brief, here's Yahara with more. Hey, Yahara.
Hi, John. President Trump says he plans to attend Charlie Kirk's funeral next week in Arizona. He also says he plans to posthumously honor him with the Presidential Medal of Freedom. Kirk was shot and killed while speaking on a college campus in Utah. His casket was flown to Phoenix yesterday aboard Air Force Two with J.D. Vance and his wife accompanying Kirk's family. Meanwhile, New York City Mayor Eric Adams is telling business and civic leaders he's conducting his own polling to decide the future of his re-election campaign. Polls currently show Zohran Mamdani holding a sizable lead and former Governor Andrew Cuomo with a more viable path to beat Mamdani. Campaign officials said Adams has, quote, never alluded to leaving the race. And Tesla's robo-taxis may be coming to Nevada. Elon Musk's company has been approved to test its autonomous vehicles in the state after launching in Texas in June. The service does include a Tesla employee sitting in the front passenger seat. Tesla also has a non-autonomous ride-hailing service in the San Francisco Bay Area. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, the race to replace Fed Chair Jay Powell.
We are getting the process underway. Obviously, it's going to be President Trump's decision, and we're not in a rush. There's a long list, and like I said, there's some great candidates.
And the list might be getting longer. George Pollack of Signum joins us next, live from New York City this morning. Good morning. Steve Author, Federated, with us just moments ago, looking for 7,500 on the S&P 500 year-end next year. Very constructive on this equity market. Equity futures at the moment pulling back just 0.1%. Jonathan Golub, now over at Seaport Research, looking for 6,700 year-end this year, saying the economic backdrop is constructive, credit, rates and policy are supportive.
You know, a lot of people coalescing around this idea that equity markets can keep going up on the dynamism of tech and what AI might do. The bigger question to me is not the stock market. Frankly, it's the bond market, because this is predicated on the idea of a Fed that's easing in the short term at a time where we're heading into a reacceleration. This is going to ostensibly come without inflation. A very big question mark around the long end of the yield curve.
Big rally at the long end more recently, and we'll be talking about that in about 10 minutes' time, so look out for that conversation. 10-year bond yields this morning up by around about a basis point. Under surveillance this morning, the race to replace Fed Chair Jay Powell.
I'm not really sure what the Federal Reserve is looking at, because thus far, we've seen very little, if any, price pressures from the tariffs. We are getting the process underway. Obviously, it's going to be President Trump's decision, and we're not in a rush. There's a long list, and like I said, there's some great candidates.
So here's the latest this morning. The U.S. Treasury Secretary Scott Bessent looking to expand the list of candidates to replace Fed Chair Jay Powell. According to reports, Bessent recently met with former Fed officials Larry Lindsey, Jim Bullard, and Kevin Walsh.
This is the start of a process. We know that there's 10, 11 names circulating when it comes to the Fed chair himself or herself. And these are the first 3 of these long interviews. What I would say is that the President Trump doesn't love process as much as I think as a Secretary Bessent, but I don't get the urgency anymore from this administration. And that is because the data is moving to seeing a Fed rate cut next week. So they have, I think, a little bit of breathing room to take their time and go about this in a methodological approach to actually have a process. I think one thing that potentially is going to come up in these interviews is how the new Fed chair could shape the Federal Reserve based on really a scathing essay in the Wall Street Journal where Bessent basically compared what the Fed did to the COVID pandemic and a terrible virus that took control of the economy.
There seems to be a big difference in the way that Wall Street and the Treasury is talking about inflation and the way that some people might be experiencing right now. I think Paul Donovan over at UBS has done a fantastic job of really explaining this. On Wall Street, we take a massive basket of goods and services and spit out a number and say what it might mean or might not mean for the Federal Reserve. At home, there's a thing called frequency bias. It's what do you come across every single day? What goods or services do you use? And a fantastic example of that is, say, coffee. Everyone wakes up, most people, reaches for a cup of coffee, and they realise the price of that has been going up aggressively, up 20% over the last year. And that is going to set their view on what's happening with inflation. And they're going to have a very different perspective, real-life perspective of what is happening in their life compared to what we're talking about around this table.
Which is the reason why I think a lot of people are looking at consumer sentiment. We'll get another read today to understand exactly how that's filtering into the decision making. I personally don't buy blackberries when they're above $7. I think that that's outrageous, and I just put them back. And fruits and vegetables just went up significantly in the latest CPI report. But you aren't seeing a lot of the sales fall off a cliff except for Restoration Hardware. So there's this question going forward of what is going to be the trigger point to bring down prices, right, if consumers are not going to push back. And that's one of the questions that's really been underpinning this.
To talk about some of these issues, George Pollock of Signum joins us now for more. George, welcome to the programme. Let's start with the Federal Reserve and work our way through things from there. So the Federal Reserve audition continues. The interviews will continue to build over the next several months. George, what is less clear are the kind of characteristics that this administration are looking for, both the Treasury Secretary and the President. What do you think they want from an incoming Fed chair?
So with the incoming Fed chair, I think they want 2 things. I think they want a strong resume to show to the market to say we're taking this seriously. We're not appointing someone who the market won't follow, who the market won't respect. But at the same time, they're looking for someone who will embrace monetary policies that are more in favor of the president's policies and more in line. Well, maybe not explicitly being so, at least showing some kind of independence of thinking and independence of thought.
Well, wasn't that the number one question when Donald Trump, when he was the 45th president, ended up asking Jay Powell to decide whether or not he should get the chairmanship job?
Yeah, absolutely. That's a very fair point. But I think the difference is that was the first Trump administration where he still had people around him who were trying to curtail his instincts and trying to push him to do certain decisions that they favored. With this administration, with Susie Wiles as chief of staff, what we're seeing is they're basically following the president's lead and making sure they're embracing his ideas and embracing what he wants.
Given the fact that the Fed is already going to be cutting interest rates when they decide to pick a new Fed chair, how important is this person going to be in terms of rethinking the Fed and how they operate?
I think even with the Fed cutting rates, as you guys were discussing, it will still be important for the administration to have their imprint on the Fed itself through the Fed chair. As we saw with the nomination of the likes of Myron for the Kugler's remaining term, they want people who are disruptors. They want the people who have thought about Fed independence, who have thought about the structure of Fed, and really do intend to see some reform executed.
George, are we being played? I kept wondering that when we saw more names come out, and I felt like they're just going to name Chris Waller, and we're just sort of getting other names thrown at us like fodder, fish bait, for us to talk about to just sort of keep the pressure up on the Federal Reserve. Is that your takeaway?
I think my takeaway is to an extent we're getting played. I think they're seriously interviewing these people because they want to hear their thoughts, they want to see their views. But in the end, I think we're going to end up with someone like Christopher Waller or maybe one of the 2 Kevins.
What do you think is going to be sort of, they love that. We had a long discussion about whether they like being called the Kevins or not. I wonder if you do think, though, that whoever is going to be the next chair, and this is something that's making its way into markets a bit more, is going to be creative about the way they use their balance sheet, maybe not expand it, but be willing to work with Treasury, whether it's Operation Twist, whether it's whatever creative instrument you can imagine, to keep longer-term yields lower. Do you think that that is actually increasingly part of these discussions?
I don't think they would ever say that openly because I think that would disturb the market. But I think the understanding is the Fed chair they pick, they're not going to make, as they view it, the same mistake they made with Jerome Powell. They're going to choose someone who they feel will be with them, maybe not openly, maybe not campaigning with them, but at the very least backing their ideas and backing their policies.
George, I wanted to go further with something that we were talking about around the table just moments ago, and that's how maybe consumers are viewing the economy at the moment and how Wall Street, the Treasury and the administration is talking about it. George, the Biden administration rightly took a lot of criticism for gaslighting the public around the conditions in this economy, talking about how great Bidenomics was at a time when a lot of people were struggling to get by. George, is there a risk that we repeat that? Talking about an economy that's doing well when the labour market data says it's not. Talking about prices coming round and inflation being well behaved at a time when a lot of people are experiencing higher food prices, higher nat gas prices. George, do they run that risk down in Washington, D.C.?
I absolutely think they're running that risk. I absolutely think they're following in the Biden administration's trend, be it for better or for worse. And the story about the not buying BlackBerries was that once they go above $7. The interesting thing is, though, there was a recent poll this week that laid out 55% of Americans, as of today, are not letting tariffs decide their purchasing decisions. So that means while there is still around 37% who say it does, a majority of Americans are still not feeling the effect of the tariffs or maybe not allowing the tariffs to affect their purchasing decisions.
That's good news, at least so far. George, we appreciate your take. Thank you, Serge. George Pollack there of Signum Global on what's happening in this economy and the Fed race.
So his point there was really interesting, and you have a great question here about at what point will people push back against some of the characterizations of the labor market and of the inflation backdrop and say, that's not my experience. How much are people conditioned to have a little bit more inflation? And how much is this what companies are able to exploit by raising prices, passing it along? Remember, right after the pandemic, we were coming off a period of no inflation for decades. So it was a very different kind of paradigm that people were getting used to.
I'm not sure you, Mitch, is going to help later, which, as we know, has become a political poll and not an economic survey. The spread between Republicans and Democrats and the way they view this economy at the moment seems to be incredibly wide.
I'm looking at the totality of surveys to really get a sense of it. I think
well said,
thank you. I think
Chair
that's
Powell
the way
would be
to go.
proud.
So Fed speak.
Coming up on the programme, we'll catch up with Sheila Kahlu of Jefferies as airfares take off. Bramo's going to tell you her price for what she won't pay for a trip from New York to the West Coast.
Stingy
What's the line in the sand? $7 for blackberries.
Well,
my line would be more like $5.
Yeah, well, I don't.
$5.
Yeah, I know, but it's you get the really big one, but you have to see, and sometimes they jack up the prices.
Like the jumbo pack.
Yeah, well,
That's different.
But when they're actually bigger and they look really good, sometimes you have to go for it.
They're not the organic ones.
Look at that. They're
the ones that have been juiced.
All right, cut it out. Stop having criticism.
Equities doing okay. We're down about 0.1% on the S&P 500, but arriving into Friday at all-time highs on the S&P, on the Nasdaq, looking for a 6th consecutive week of gains for small caps. That rally hasn't stopped since that weak July payrolls report reported in early August. And we've seen some big moves in the bond market since then too, particularly at the front end of the curve. 2's around 350, 355 this morning. 10's around 4.03%. The long end has outperformed the front end over the last week or so. This is important. Check out 2's and 10's. Just want to sit on this chart and just speak to you about what's been happening here over the last month. 2's, 10's, since the start of August, the end of July, has gone from the 40s to the 60s. That was a steeper curve led by the front end. That's called a bull steepener. What's happened since then, since we've arrived into September, is we've gone from the 60s back to the 40s. And it's been driven by what's called a bull flattener, driven by the long end. This is really, really interesting at a time when a lot of people came into the post-Labor Day period positioned for a steeper yield curve and more of the same. PIMCO's Dan Iverson, one of the very best at it in fixed income, backing away from the steepener, speaking to Bloomberg saying it's performed so well that our conviction level has come down, and maybe he's not the only one now.
Well, This raises the question, is this flattening, the sort of bull flattening that you're talking about, is that signal or is that noise? Is this people stopping out positions that already performed very well, or is this a signal that as the Fed cuts rates, there isn't going to be this concern about runaway inflation and there still will be demand for the long end of the yield curve? I would say the jury is still out because you have other people like Dan Ivison who are saying the same thing. Essentially, longer term, they see a steepening, but right now, short term, they see this flattening. This, to me, is one of the most complicated trades I could possibly imagine, and it really will be important, especially given Scott Besant's goal of getting 10-year yields down to 3%.
This is one of the biggest consensus trades in the market right now, and the market is pushing back against it, at least so far in September. Early days, I know, but yields are backing away from the highs we were talking about 2 weeks ago. 5% on 30s, more like 465 this morning. 10s at about 4.04%. 2 hours away from the cash open. Let's focus on equities now. To get your morning movers, here's Danny. Hey, Danny.
Hey, John. It's been a really big week for AI infrastructure stocks after Oracle earlier this week, but now it is the turn of Supermicro getting a big boost, up more than 5.5%. It says that it has started rolling out its servers that include the most advanced NVIDIA Blackwell Ultra chips. It's ones that help with more complex computing processes. For these types of companies, it's really a race to see who can deliver with NVIDIA chips the fastest, and Supermicro seemingly ahead of the curve. Elsewhere, we also had an analyst upgrade by Barclays to GM, taking it from equal weight to overweight. Those shares rallying off the back of that. Barclays analysts saying that things like more soft regulation when it comes to EVs and just generally pricing power still for autos helping a company like GM. They also say its valuations look attractive and buybacks look good, hence the upgrade for them. Now, as far as earnings, we also heard from Adobe after the bell yesterday. Again, another AI story. It seems like all of their AI innovation is paying off. Morgan Stanley analysts noting that going into the earnings, there was a real question to whether they'd get that return on investment. They gave a pretty punchy outlook, surpassing estimates. So those shares up 3% because everybody wants to Photoshop themselves with AI. John?
Danny, thank you. Bit loose and fast with everybody. Don't want anything to do with that. The photoshopping with AI.
Yeah, I want
people changing their pictures. You've seen people are doing that with their LinkedIn photos now.
Yeah.
That you take your own photo, then you push it through.
Or dating apps. Yeah,
right?
That's always an interesting one.
Imagine them turning up for the date and
exactly.
finding out
Well,
the
there you
person
go.
sitting across from you is not the person you thought it was.
How do people handle that? Do they get up and walk away?
I think they walk away.
You think so?
Honestly. Someone speak with experience there. That was pretty fast.
You want to say anything else on that?
Filter, AMH. Filter. Let's move on. On our radar this morning, the FBI releasing new video of the suspect in the assassination of Charlie Kirk. Surveillance footage showing a person jumping off a building and fleeing the scene just after the shooting. Any developments here, of course, will continue to bring you them. Elsewhere, Treasury Secretary Scott Bessent discussing trade and TikTok with the Chinese Vice Premier in Madrid next week. The meeting laying the groundwork for a potential summit between the President, Donald Trump, and Xi Jinping.
This is going to be a big one because this is the third of a series of meetings between U.S. officials and their Chinese counterparts. Pete Hegseth, Marco Rubio both spoke to their counterparts this week. And then final, you send in Scotty B, maybe sealing the deal for this leader-to-leader meeting can happen potentially on the sidelines of the APEC summit. What I struggle to understand is when the United States sits down with China, what's going to be their number one ask? They are dealing with fentanyl. They need China's sign-off, the Communist Party sign-off on a sale of TikTok. They are dealing with China dumping on other markets. They want China to purchase U.S. agricultural goods, the phase one trade deal, which they have not lived up to. So this is going to be very delicate when it comes to Xi Jinping and Donald Trump sitting down together.
It's super delicate. And also in the mix of all of this, I think the Mexico story is fascinating. We're going into next year. Mexico and Canada want to come to some kind of agreement with the US on USMCA and the future of a trade relationship. What Mexico knows it's got to do is put up the walls to Chinese imports to make sure they can smooth the runway, foam the runway, to make sure that things are going to be okay next year. China's basically trying to bully Mexico. At the same time, these two are getting together in Madrid. I think that's one of the most interesting stories in global trade right now.
How does the U.S. come to some agreement with China or even the parameters for it at the same time that the U.S. is encouraging Mexico to put up the walls and China is going after Mexico and saying the U.S. is a bully and we don't ascribe to such bullying tactics and we want free trade? There's a real question here about how all of these other stories, and I'll add to the complexity, the issue with Russia. How do you get China to agree to pressure Russia to end the war without putting secondary sanctions on and without further inflaming some of the concerns? So the geopolitics of this, I think, are fascinating and what messaging the U.S. sends.
The United States is basically going to tell these countries like Mexico, like Spain, the Europeans, you have to choose. and you better be choosing with us. They're also going to remind them that if you decide to go down this road of choosing China, you're going to destroy your high-end manufacturing base, and you're going to be basically crying for the next few years because it would be cheap now, but you're going to have to pay for it later.
It's going to consume your manufacturing base, and we're seeing that take place potentially in Germany and the auto industry across the continent. Wanted to squeeze this story in, looking ahead to next week. Nvidia, OpenAI planning to invest billions in UK data centres. The CEOs set to make that announcement when they travel to the country next week. Their trip coinciding with President Trump's visit to the UK. You'll be there.
This will be an interesting one, of course, because we have seen the president do this in his prior trips to the Middle East. He brought likes of Jensen Huang along, and they were inking deals. What I find really interesting about this is I'm missing some other names. Where is Mark Zuckerberg? Where is Tim Cook? Are these individuals going to go with him? And what has been proven is if you go on some of these trips, like Jensen Huang, you get a lot more say on what is going on in the Oval Office and policy than when it relates to your industry.
Important question. You've screened the prices of flights. How expensive was the transatlantic trip this time? Is it going up?
It was expensive.
Was it?
It was very
Do you
expensive.
think that was just for next week? Or do you get a sense that everything's just had a little bit of a lift?
I think everything has had a little bit of a lift based off the rants I hear every morning from Lisa.
I'm asking for Bramo.
Well, I could just say we could see it from August CPI, 5.8% increase, which was definitely interesting. But to me, I take a look at the peak times vacation, and when it crosses a certain line, my God, I sound horrible. She has a lot
of lines in the sand.
No one gets a vacation once you go over a certain number.
We get a different kind of vacation, that's all. I just tell the kids,
Cruises.
ratchet it back.
Elisa said it, a move of 6%, almost 6% in airfares in August CPI from the month before. Sheila Kolu of Jefferies is following this too. Sheila, good morning. It's good to see you.
Good morning. Thank you.
Is this the real deal? Do you think this is the kind of thing that can stick around?
Every point of price is about 10% of earnings for airlines, so it is a big deal. But we've seen airline prices essentially be deflationary over the last 4 or 5 years. So this is finally some momentum, and what's resulting is capacity is coming in. We're seeing capacity down 1 to 2 points, and that's helping price just move up into positive territory.
How much is this price increase an average that isn't representative of all of the potential offerings? I saw yesterday Delta put out an 8K, and it sort of highlighted how Delta gets more than 50% of its revenue from seats outside of the main cabin. In other words, premium offerings. And it just highlights that people who are feeling the wealth effect and are wealthier are fueling some of these price increases maybe than the back of the cabin.
Yes, it's definitely for folks that buy BlackBerries over $7. This is what's fueling the demand for Delta Premium One. But Delta's 8K really just raised the midpoint of the guidance 1 to 2 points, so 2 to 4% revenue growth in Q3. So we're not talking big numbers here that's moving these stock prices really. So it is 50% premium. Corporate's just coming back. But Delta still talked about weakness in Atlantic, main cabin pressure as well. So it's not all parts of the market. United refuted that and said everything is great in all places of United. So they were more bullish.
Well, how much are some of these airlines reducing capacity in order to keep prices high? And I'm saying this because simply their overhead costs, especially with personnel, have gone up. They want to maintain some of that personnel so that they don't have the same situation as during the pandemic. And you end up with higher prices no matter what.
We're looking at capacity for airlines down about 1% over the last month. TSA volumes are up 1%, so it's only a 2-point spread that we're seeing. So capacity coming in 1% is really helping that price. Some of it is low-cost carriers going out of business that's driving and fueling this demand. And then in terms of costs, a lot of the labor agreements are in. Delta called out higher costs related to weather in Q3, so it was more just seasonal rather than a long-term issue for costs.
You mentioned low-cost carriers. What's going on with United and Spirit? The Spirit Airlines CEO saying United CEO can't stop, quote, yapping about us.
Scott Kirby tends to be an outspoken person for the airline industry, and he's done well in terms of raising visibility for airlines, saying there's brand loyalty associated with airlines, and I do think that's true, whether it's the Mileage Plus program or Delta One. Once you fly that, you tend to go on it and you look less for what the airfare price looks like. So I do think that Delta and United are bringing brand loyalty back and trying to say, we don't need to trade at 5 times earnings or a 70% discount to the market. We could have sustainable earnings.
Is Scott Kirby, though, right about Spirit? Are they going to go out of business?
Low-cost carriers in the U.S., there's just too much capacity going into the same markets. And then that's where you see promotional airfares from Southwest Airlines and the like. And so you don't really want to fly the routes, the most lucrative routes. where you're making 20% margins are those transatlantic flights.
I noticed you haven't really mentioned American. You've talked about United, talked about Delta. Has American still got a problem?
That's where my loyalty lies, Delta and United, in terms of my personal flying. But in terms of American, I do think they're the third sort of network carrier in the U.S. They have a subpar product domestically and internationally, and they're trying to improve that by improving their wide body.
What makes it subpar for you? What is it that they're doing that is subpar compared to, say, the Deltas of this world?
I think Delta One has invested so much. They have 3 main hubs with the Delta One lounges in the U.S., something like $3.4 billion of investment at JFK alone. So the return on that is to gain a little bit of market share, and they've done that successfully because folks like me who flew American in 2019 are now flying Delta because they've invested so much in the infrastructure and the cabin and on-time delivery, on-time arrivals. Same thing with United. So you could see the investments really helping brand loyalty.
Sheila, appreciate it. Appreciate the honesty too. Subpar American Airlines. Sheila Kohli there of Jefferies. I don't know if they're listening this morning, but
I will get a call if they are.
That's the conclusion of a lot of people.
That hit hard for you. I know. It's sort of what
here's the problem. Yeah. And Annmarie understands this.
We're one world.
If you're coming from London, you've probably been flying BA, which means you're one world, which means ultimately you just sort of drift over to American almost accidentally.
Yes, and also I used to fly to the Middle East a lot. Qatar is also one world, which is not subpar. And I recently flown American, I have to say. I thought it was a good experience. And they've updated the lounges. It seemed pretty seamless.
You're happy with that, all right? Yeah. We're balanced here at Bloomberg Surveillance. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Former Brazilian President Jair Bolsonaro has been sentenced to over 27 years in prison. He was convicted on charges he sought to cling to power by plotting a military coup that included plans to assassinate President Luiz Inácio Lula da Silva. His lawyers are expected to appeal his sentence. The U.S. has warned it will act accordingly to what it called a witch hunt. Meanwhile, Treasury Secretary Scott Bessent is adding additional names to the list of candidates to replace Fed Chair Jay Powell. In recent days, Bessent reportedly met with former Fed officials Lawrence Lindsay, Kevin Warsh, and Jim Bullard. Powell's term expires in May 2026, and while he could stay on for 2 more years as governor, Trump is anxious to replace him as chair. And shares of Warner Brothers Discovery are surging nearly 5.5% in the pre-market following reports that Paramount Skydance is preparing a bid for the company. Sources say Warner Brothers CEO David Zaslav believes he can get a hefty premium for his streaming and studios businesses once they're separated from the cable business. The Paramount offer is being backed by the Ellison family. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. Up next on the program, a new rally in the bond market.
I think the long end of the curve has actually done most of its rallying. What we think you'll see instead is short bonds will rally. We think equities can continue to rally. But that long end, I think, probably has a little less opportunity.
A conversation up next with Sam Zeef of JP Morgan Private Bank, live from New York. You're watching Bloomberg TV. Equity futures this morning, negative by 0.1% on the S&P 500, just about unchanged on the Nasdaq 100, coming into Friday at record highs. Under surveillance this morning, a new rally in the bond market.
What is most likely to happen is, kind of 2-year yields are likely to come down to where the federal funds rate is headed. We think that's 3%. 10-year yield at, essentially 4%. We think that's about where it belongs. We think the long end of the curve has actually done most of its rallying. What we think you'll see instead is short bonds will rally. We think equities can continue to rally. But that long end, I think, probably has a little less opportunity.
So here's the latest this morning. Treasury yields nearing lows of the year as traders price in further Fed interest rate cuts. Sam Zeef of JP Morgan Private Bank saying the following. Fed rate cuts can stimulate the economy even if long-term Treasury yields don't decline. Sam joins us now for more. Sam, good morning.
Thanks. Good morning.
Good to see you. Let's throw some of that into foreign exchange. Yep. Can you help us understand what kind of market regime we're in right now, whether it's relative rates, whether it's yield differentials, growth differentials? What's driving things at the moment?
Yeah, it's definitely compared to
to early this year, around Liberation Day or Q2, there was always the kind of yield differential story, and it had totally fallen away, and everything had become about flows, American exceptionalism, the Sell America story. And really, since then, over the summer and into right now, that story has completely faded away. We don't see it in the data. We're not seeing signs of repatriation or big asset allocation flows. And it's really been the correlation between yield differentials and the dollar that has reasserted itself. So when we think about our expectation that the dollar can sell off a little bit more, 3 to 5% into next year, it really comes down to the yield story and the relative growth and rate story.
So when you put this together, do you buy the yield flattener, the yield curve flattener that we've seen? Do you think that that's a lasting trade?
In the long end, no, this is probably more of a counter trend rally in our view. We really just think you get the diversification benefits and the yield that you need from the Treasury yield curve in the intermediate part of the curve. We don't see tons of reasons to go out into ultra long duration, particularly when it comes to Treasuries, or really globally in sovereign bond markets, given fiscal concerns, given debate around political volatility. And really, I think you can see it. We were talking about this before. You can see it in gold. 10s, 30s, steepening year to date. Gold continues to rally. So we get a lot of pushback on our dollar view saying, oh, the dollar is stubborn. It's not selling off. Euro dollar is stuck here. And that's right. But not against gold, not against precious metals. The dollar is continuing to devalue there. And that's actually, at least at the private bank, where we've been really expressing our bearish dollar view, has really been in the precious space and in gold.
So when you take a step back, you said that cutting rates at the front end can still stimulate the economy, even if you end up with higher long-term rates. Can you talk about exactly how, given the fact that the transmission mechanism, a lot of people are saying, has been, if not broken, really muted?
Yeah, I think people think about, oh, Fed rate cuts, long end comes down, mortgage rates come down, refinancing rates come down. But I think it's really important to think about not only how we think about it, but the Fed is in terms of broad financial conditions. As long as if the fact that the Fed is getting more dovish or bringing the front end down results in tighter credit spreads, higher equity prices, maybe a weaker dollar, improved sentiment, then financial conditions ease, and that's what transmits into the real economy. And actually, if you look at the Fed's own FCI models, just given the easing of financial conditions we've gotten over recent months, Fed hasn't even cut yet. It's going to boost growth all else equal 30, 40, 50 basis points over the next 12 months.
They're expected to cut next week. So help us understand what you're expecting next week. Is that going to be a one-off adjustment or the start of something bigger?
Yeah, we think it's the start of a full return to neutral. We really don't think, given the loosening in the labor market, or certainly lack of retightening in the labor market, that you need rates in restrictive territory anymore. So we think it's the start of the process to bring rates back down to around 3.25. So we have penciled in about 100 basis points of cuts over the next 12 months. We can debate how fast we get there, but this is the first step. And the fact you're going back to neutral is really what underpins our investment.
Well, let's talk about speed. How do you think about speed at the moment when we could have a different Fed chair arriving in May with a very different view of what to do?
Absolutely. I think they want to get the process started. The Fed itself has given some speeches that say kind of get on with it. And so I think they want to get the process started. Look, the market, at least, again, I go back to the idea that we focus on financial conditions, broad financial conditions. As long as the Fed delivers on the roughly 100 basis points of cuts that are priced at some point over the next 6 to 12 months, that shouldn't tighten financial conditions and threaten the outlook. Maybe it's, downplaying their actual actions, but it's already priced. It's already transmitting through financial conditions. So as long as you kind of deliver on it, you're going to get the stimulus that it involves.
Does it make you want to buy U.S. debt more with a backstop potentially of a Fed that is going to try to be supportive in whatever way that it can, both on the short end and the long end, depending on who comes into the office?
Yeah, I think the key is we are going to have a Fed cutting cycle, let's call it. Other underpinning belief that we have is that the economy is not going to slide into recession. And when you have Fed cutting cycles that don't accompany recessions, your kind of playbook for asset prices is very different than if the Fed's cutting into recession. So going to bonds in particular, front end performs, gives you yield, gives you diversification. The long end, if you look across cutting cycles that don't result in a recession, long end stays flat, maybe even moves higher over time. So we're really like being in the belly of the curve and in. And then when we're trying to find yield in the private bank to make up for the fact that cash rates are on their way down, we've really been looking more into ultra high quality, investment grade credit, taking a little bit of credit risk in the high quality companies because treasuries are already really pricing in a big easing.
Why aren't you going into Europe, given the fact that they just forecast inflation coming in below that 2% level and still see growth, albeit tepid?
Yeah. It's not that we're against going into Europe, but on an FX hedge basis, it doesn't really give me much relative to the U.S. And I think what we heard from, the ECB yesterday is that they're done cutting. right? We're kind of 50-50 in our own debate about whether they deliver one more cut or not. The real difference in global sovereign bond markets is that most foreign central banks are done with their cutting cycles, and now the Fed is catching up. And that's the theme that we're going to be trading.
The ECB forecasts are amazing for me. I keep going back to these growth forecasts. GDP for this year, 1.2%. For next year, around 1%. For 2027, around 1%. We talked about this yesterday. What happened to all the hope and enthusiasm about the European growth story? The ECB just turned around and told you yesterday they're expecting growth around 1% for the next 2+ years.
They turned around and they said, be happy it's not a recession, essentially, right? I mean, this is sort of how low the bar was. But you're right. Where is that dynamism? And that's one reason why, as much as people were saying, sell America, go into Europe, we really haven't seen it sustained. Yes, in certain pockets of the equity market, but you've seen those flows reverse in certain pockets over the past couple of months.
Besides the defense sector, where are you going to be investing in Europe? And what we've seen, especially in autos, is China just absolutely destroying the sector across the continent.
It was interesting that they believed the disinflationary story might be over on the continent when we still haven't really concluded what's going to happen with trade for next year and beyond.
Well, and that's why Christine Lagarde said that the risks around the view are high. But it is notable that right now we are heading into a weekend of meetings between the U.S. and the Chinese counterparts in Madrid about exactly what the trade landscape looks like. That is a huge risk. And how do they deal with this inflation? How high is the bar for them to act in a more stimulative manner, given the fact that they do have a singular mandate, but it seems like mission accomplished based on their own forecasts?
Sam, it's good to see you. Appreciate your time. Sam Zither of JP Morgan Private Bank with a big call in the FX market. Dollar weakness, if you want to see it, see lots of it. Look for precious metals and what's been happening this year.
To me, this has been stunning. The fact that we had, on an inflation-adjusted basis, record high prices, more than $3,600 per ounce on gold. The precious metal has just been ripping higher. And this really is where you can see some of this question around the dollar and where its role is in the global economy. And this is where you can see buying by central banks, particularly in China, that tends to be underreported time and time again. So, again, if you want to buy a ring, good luck.
Gold up again this morning by 0.4%. The good news is diamond prices are like,
yay,
rock bottom.
All right, well,
there you go. Just trying to bring a smile to people's faces, Bramo.
And you're doing a great job.
Trying. Coming up, Tracy McMillan of Wells Fargo, Gil Luria of D.A. Davidson, Stephanie Roth of Wolfe Research, and Krishna Mamani of Lafayette College. The third hour of Bloomberg Surveillance up next.
We've been concerned about inflation for a while.
We're getting what we expected on inflation.
You are seeing more evidence of a softening in labor market conditions.
The economy is gradually grinding to a halt here.
The economy is set to reaccelerate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
4-day winning streak on the S&P 500, 6 on the NASDAQ 100. We're looking at all-time highs arriving into Friday from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures negative by not even 0.1%. On the NASDAQ 100, up by around about 0.1%. In the bond market, decent rally at the long end of the curve so far this week, taking bond yields down to around 4%. Yields a little bit higher this morning by 2 or 3 basis points. One more data point left before we get into the weekend, the big one, drum roll. You, Mitch. You know how much we love you, Mitch. It's not even an economic survey. It's become a political poll about how Republicans and Democrats feel about the economy.
Well, look, we're going to be looking at it because it is something that comes out, and it's one piece of the pie. It sort of has been less and less of an indicator. I think a lot of people are with you. That said, one thing that's been notable is that consumer sentiment has held in better than you would have expected, given that inflation is still as high as it is. And I think that that's the tension that you're talking about, which is if people say that inflation is low enough to start cutting rates, is that sentiment reflected in the population, especially at a time of slow labor market growth? And that, I think, is a really good question that we're looking for tea leaves to try to understand.
We can all sit around this table and look at this poll, what it is, not a survey. It really is a poll and has a lot of political bias in it, and say, who's really going to be paying attention to that? But the Fed actually paid attention to the University of Michigan last time around.
The Fed's not paying attention to inflation this time around. I guess that's the big change. Chairman Powell set us up for a very different meeting next week when he addressed Jackson Hole, and you were there. That line in that speech that we've repeatedly on this program, that he expects inflation potentially to be a one-off, but not all at once, phenomena, That basically means this Federal Reserve is ready to look through hot inflation prints into year-end and maybe beyond.
The fact that this market is pricing in 75 basis points of rate cuts, even when we haven't seen inflation at that 2% target for more than 4 years, tells you a lot. And I think that a lot of people are saying they're willing to look through any short-term inflation pop. My question is, are they willing to look through a 6-month or 8-month inflationary kind of wave? And it really goes to the core of why is the long bond rallying? Is it because people truly believe that inflation is going to come in? Is it just a trade that is getting stopped out because it was so consensus and we're trying to put a narrative around it? Or is this something else about how the Fed is going to adjust its policies and its balance sheet to have a little bit more influence over the long end as well as the short end?
That meeting coming up next Wednesday. Equity futures at the moment pretty much unmoved on the S&P 500. Coming up on this program, we'll catch up with Tracy McMillan of Wells Fargo as stocks trade near all-time highs. Gil Luria of D.A. Davidson shaking up his outlook for big tech, and Stephanie Roth of Wolfe Research on rising rate cut bets. We begin this hour with stocks steady ahead of next week's Fed meeting. Tracy McMillan of Wells Fargo writing Fed Chair Jay Powell is more focused on employment data than inflation data for now, and the bond market knows it. Tracy joins us now for more. Tracy, good morning. Can we talk about the rally, not just at the front end, but the rally further out along the curve at the long end? That long end starting to outperform. What do you think's behind that?
Good morning. Yeah, so we think that it's outperforming because there are a number of rate cuts priced into the markets. And we're seeing the yield curve shift down across all of the maturities. So we think that's really what's behind that. We don't think, however, that the 10-year gets much below 4%. You know, if you just do a little simple math, 2% growth, 2% long-term inflation, you're at 4% without a term premium. So we really do think that's probably about the floor for the 10-year.
What's the relationship between that and that view and what you expect to see in equities?
Yeah, so what we expect to see in equities is potentially some choppiness here in the near term. And that has to do with a number of risks, one of which is that we could see inflation higher than the Federal Reserve is comfortable with, and the markets may need to ratchet back some of their rate cut expectations. And there are a number of other risks that we see that also could play into a choppy market here. But longer term, we see markets recovering in 2026.
So you see that even if there's a sell-off at the long end. I mean, to me, I thought that one of the most interesting notes overnight was Torsten Slok coming out and saying, what are the implications of not having a risk-free asset? There's a question about whether the stock market can power ahead, even if there is choppiness in yield curves as well.
Yeah, so what we're seeing is that if there is choppiness in yield curves, and we also anticipate that we could see some lift at the long end of the curve next year. However, we don't think that it's going to be an all-out sell-off of the U.S. Treasury. The U.S. continues to have the dollar as the reserve currency of the world. The U.S. also has the ability to issue debt in a way that it can help to manage what yields are further out the curve. So we don't really see those numbers, those yields rising so significantly that it puts a rally in the stock market in peril.
And this is one reason why some people are saying that the recent rally at the long end has more to do with expectations around what the Fed can do in order to adjust some of its policies to keep yields within a certain level. I'm just wondering, Tracy, going forward, what do you think is going to be the leadership of an ongoing stock rally? Do you believe the sort of cyclical tilt that we're seeing right now, or do you think it's going to be the tech giants that keep powering it ahead?
Yeah, so really it's likely to be the tech giants that continue to power us ahead. Our favorite sectors are information technology, financials, and utilities. Information technology, because we do believe that the investment in AI is really just getting started. And utilities benefit from the build out and the operation of those data centers. Financials are benefiting from a yield curve that's rising on the long end.
When you look at the tariff impact, you talk about, you write in your note about they're arriving in piecemeal. What kind of timeline is piecemeal?
Yeah, so obviously some tariffs have already been implemented, but certainly not to the extent that we thought back in early April. What we see happening is that as court decisions come through that tell us whether or not the current policy is legal, and whether or not the administration has to then reconsider how they implement tariffs, that could cause the tariff policy to be extended. And even as it is today, many tariffs are still in negotiation, and still in flux. So we see it being implemented, across the next few quarters at least.
So are you basically saying that we're going to be living in tariff purgatory, almost maybe as long as the Trump administration?
Well, we hope not. We do hope that there is some clarity over the next couple of quarters.
Tracy, we've got to leave it there. Thanks for joining us. Tracy McMillan there of Wells Fargo. Just got some breaking news. Want to get you a quick update and cross over to Yahira for more. Hey, Yahira.
Hi, John. Exactly. President Donald Trump says the suspect in the killing of Charlie Kirk is in custody. He says someone close to the suspect turned him in. Meanwhile, Utah Governor Spencer Cox says the state will pursue the death penalty against Kirk's killer. Meanwhile, Treasury Secretary Scott Bessent will meet with Chinese Vice Premier He Lifeng in Madrid next week. The two will discuss trade, economic, and national security issues. The discussions will also cover TikTok's status and efforts to combat money laundering. A 90-day tariff truce between the U.S. and China is set to expire in early November. And OpenAI is moving closer to restructuring into a more traditional for-profit model after months of negotiations with its top shareholder, Microsoft. Chairman Brett Taylor says the nonprofit parent will keep control through a new public benefit corporation and hold an equity stake worth at least $100 billion. But its restructuring faces opposition from Elon Musk and state attorneys general. That's Bloomberg Brief. John?
Yahira, thanks for that. Just to recap the breaking news crossing just a moment ago from the President of the United States, saying he's just recently found out that with a high degree of certainty we have the suspect following the killing of Charlie Kirk, saying the suspect is in custody and that according to the President of the United States, somebody close to the suspect turned him in. The President going on to say that I hope the killer of Charlie Kirk is found guilty and gets the death penalty. More on that story later this hour. Up next on the programme, we'll turn back to the markets. The morning calls, plus Gil Luria of D.A. Davidson shaking up his big tech outlook. That conversation up next.
What type of overvaluation is being placed by investment or capex at this point really is in the eyes and the ears of the beholder, because maybe the investments that are being made across the 11 sectors to participate in what AI can do really position ourselves for what is genuinely a new economy that we are moving towards.
That was the biggest bull on Wall Street, John Stolfus of Oppenheimer, looking for 7,100 on the S&P 500 year end. We're getting closer. Equity futures this morning pulling back just a little bit. We're down 0.1%, but over the last week higher. Every single day this week so far, Monday through Thursday, a 4-day winning streak on the S&P 500, taking us towards another week of gains. Record highs on the S&P, record highs on the NASDAQ, coming into Friday.
There have been 24 record highs on the S&P 500 so far this year. There have been 22 on the NASDAQ. This includes the swoon that we saw after April 2nd, after Liberation Day. It highlights how offsides people have been who have betted that this market would continue to go down, and it highlights why some people are saying the pain trade might be up even now with all of these gains behind us.
How comfortable are you with the new story? Reacceleration. That's the real risk here, that things start to pick up, that the worst of the data is actually behind us. It was June. Mark your calendar. It was June. The jobs data was terrible. And now move on. Look ahead and things are going to improve.
When have I ever been comfortable, I think is probably the better way of looking at it. And I would say just about as comfortable as I am now with that story, which is not very. And really the issue to me is there some sort of dissonance, as Andrew Hollenhorst was talking about, between a bond market that's pricing in a Fed that needs to take action and pretty significantly, and a stock market that's rip-roaring ahead? Is there some sort of contradiction and a reacceleration that's going to allow the Fed to cut without inflation coming along? It's so many different perfect little pieces that come together that, sure, I'm not comfortable, but that's probably why there still is that bearishness and probably why the bulls are dancing all over them.
Are we reaching the limits of bad news being good news? I was thinking about that yesterday. Maybe it's not the claim story. That looks like Texas, looks like a freak one-off. But are we reaching the limits of that weak labour market story being good for stocks?
The issue to me is, do we understand that weak labour market story? I was looking at a study coming out of one of the regional feds yesterday, and it was pointing to the fact that the break-even rate of labour market creation in this economy might be 30,000, not necessarily 150,000 like earlier this year on a monthly basis. I'm just saying it's hard for us to get our hands around exactly what this market is in terms of labor. And I think that's underpinning some of this idea that people are just discounting it altogether.
The opening about 1 hour and 15 minutes away. We're down by not even 0.1% on the S&P. That's the price action this morning. Let's get you some morning calls. First up, UBS upgrading Alaska Air to a buy, saying earnings are about to, quote, take off. They are this morning by more than 3%. Your second call from Barclays upgrading GM to overweight, seeing more upside potential with further tariff deal easing still ahead of us. That stock is up by 1.5%. And finally, BMO cutting its price target on Adobe to 405, citing concerns about its durable growth. That stock's still doing okay, positive by 2.5% in the pre-market. Let's stick with tech. Wall Street sentiment on Apple hitting a 5-year low after it unveiled a new line of products earlier this week. Bloomberg's Mark Gurman joins us now for more. Mark, welcome to the program, sir. It's not been a great time for Apple over the last few months. We talked about an upgrade super cycle for iPhones for the last several years. It hasn't developed. Do you see anything, Mark, in the latest unveiling that's going to encourage people to say, yeah, now's the time, let's upgrade?
Well, we haven't talked about an iPhone supercycle the last few years. Others have talked about an iPhone supercycle. To me, it seemed kind of obvious. Design is what sells. New form factors are what sells. Real AI features are what sells. And over the last few years, Apple has not had that. That's why I'm a big believer in this year's release, because new designs, new colors, new looks, new features, that's what sells. So I'm pretty optimistic for these new 17 Pro and Pro Maxes because of the new look, because of the camera improvements, because of the new colors. I would anticipate some semblance of lines this time around. In addition to people simply wanting to check out the iPhone Air. They might not buy it because it's not very practical, given the battery life and camera constraints, but certainly it's going to bring people into stores to take a look.
Mark, one thing we've heard from a lot of guests on the program, particularly the bears, of course, is that ultimately it's not about looks, it's about functionality now. What are you doing with Apple Intelligence? What steps have they taken to improve things on that front?
Well, I don't necessarily agree. I think we're about a year away from people really making purchase decisions in regards to AI features. Apple has definitely done a very poor job on implementing AI. Their rollout over the past year and a half for their Apple Intelligence functionality has been nothing short of a borderline disaster for the company. But it's not really impacting purchases. We're still, like I said, many months away from that being a real factor. People buy phones because they break their screen. People buy phones because they want a new look. And people buy phones because they have run their battery into the ground. But in terms of upcoming AI integrations, you'll see a revamped Siri in March.
Can you promise me, Mark, that if I drop this one, the Air, that it won't break?
I can't promise you, but it was actually quite interesting. A couple Apple executives did an interview with a website called Tom's Guide I saw on YouTube yesterday. And Greg Jaws, who actually had a marketing, threw his iPhone Air to one of the journalists and asked them to try to bend it in half. Because if you remember when Apple did a super thin iPhone 6 Plus back in 2014, you could just bend it in half like you're bending a piece of paper almost, right? And this guy was trying, and he could not bend that thing. So I can't promise you that if you do it, it won't break. But clearly they're confident enough to have a journalist on YouTube try to break it in half, and nothing happened.
Mark, appreciate your take, sir. Thanks for making time for us this morning. Mark Gurman there, one of the very best following this story. Let's stick with Apple. Gil Luria at D.A. Davidson downgrading Apple shares to neutral with a 250 price target. Gil joins us now for more. Gil, welcome back. You heard Mark there. A little bit more constructive about what the next year could bring. How constrained do you think the growth story is going to be? And why don't you think this story, the big unveil over the last week, is going to address that?
I do think that Mark is right about there being a little bit of a different form factor. The colors, the look is a little different, which is what has in the past driven some upgrade. But this is the type of upgrade that maybe will take us from iPhone being flat for the last 5 years to up a few single digits. That's probably not enough. To Mark's point, until AI has a big impact and drives an upgrade cycle, which was what we were expecting last year and did not materialize, we're not going to get a big enough upgrade cycle to drive the stock up from here. That's where we're at, is that until they have another breakthrough, until they have something very dramatically different, a new category, a completely new form factor, it's unlikely that we're going to get out of this low single-digit growth range.
But are they going to lose their install base, Gil? And this is actually one of the existential questions facing Apple, especially as there's real competition from the likes of Samsung and others. How much are other manufacturers of smartphones luring people away from the Apple ecosystem? Or is it just sort of a waiting process until something better comes along from Apple?
Apple turned out to be very sticky. The handsets are very sticky. Once you get into the ecosystem, especially you have multiple devices like the AirPods or the Watch or Apple TV, then you're very entrenched and it's very hard to get the consumer to leave the platform. That is why Apple trades at a premium. It trades at a premium because it's so sticky. It's hard for me to imagine 5 years from now not being in the Apple ecosystem, because of how it's wrapped itself around my usage. That is the big advantage of Apple. So even with low single-digit growth, they can grow services double digits. That's what gives Apple that premium valuation, which is well justified.
Gil, given that sort of demand, and you see it if you have kids and if you do a channel check at the high school and you see that everyone has their various Apple devices, I'm just wondering, was it surprising to you that they weren't able to raise pricing more on some of these phones?
Yeah, that is a competitive issue, right? If they start pushing the price points higher and higher, they're going to get less top of funnel. They're going to get less new users. Parents are increasingly going to have their kids have Androids instead of iPhones if the price point differential is big. They did some subtle things. Putting the Air where they did may encourage some people to go to the Pro level $100 higher. So those kinds of subtle things may increase ASP a little bit, average selling price a little bit, but not significantly. And it's very hard for them to raise prices at the low end, again, because that's where the competition is.
How constrained is Apple right now when it comes to regulatory concerns in Europe? When I walked into the studio this morning, Jonathan was talking to me about how the fact that this cool feature everyone's excited about, the AirPods that can have live language translation, actually won't be allowed in the European Union because of the Digital Markets Act.
Well, the Europeans have regulated themselves out of innovation for a while now. I don't expect that to change. But if the live translation feature works, that could be a very attractive feature. That could be a game changer. Let's not forget, Google and Meta have been trying this with the glasses, and they have pretty shaky early versions of this. I would imagine that if Apple went ahead and showed us live translation on AirPods a week ago, then maybe this is real and it will be very significant. And I would expect, if it does work that well, that the Europeans may reconsider that, because that would be a big leap forward in terms of functionality.
Right. So you think potentially they need to prove that it's working and then the Europeans might come around. Speaking of Europe, do you expect Tim Cook to go with the president next week?
He's doing his best to ingratiate himself with the president. It was almost comical to see him present the president with a golden statue. I think it was almost biblical. So hopefully that gets him close enough with the president. The president will take him there and maybe even address some of these concerns head on. Part of our concern vis-a-vis Europe is that Europe is applying these non-tariff barriers on big tech And so the president's going to want to address that. Part of it has to do with the very restrictive regulations around the Apple Store, the Android Store. And so that very well could be an opportunity for Mr. Cook to improve that situation in Europe.
Gil, before you go, shake up with your NVIDIA call as well. What's changed for you? What do you see differently and why?
We're very optimistic about the growth of demand for AI compute based on how much we're using these tools and how powerful they're being. And NVIDIA, which has done incredibly well, hasn't caught up to the rest of the AI trade. It is now the most attractively part of the AI trade. In fact, they're trading at 28 times next year's earnings. That's the same as Apple. Apple's going to grow earnings 9 or 10%. NVIDIA is going to grow earnings 30 or 40%. So for as well as NVIDIA has done, the rest of the AI trade has done so well that NVIDIA is now the most attractively priced within the AI trade.
Amazing. Gil, appreciate the call. Gil Luria there of D.A. Davidson on both Apple and NVIDIA. What a week it's been for the AI story. Oracle, so far this week, still higher by more than 30%. We've added $221 billion to the market cap of that company this week.
After they announced that they see a 77% increase of the demand for their cloud computing services, really thrusting them into the race to really cater to companies that are trying to adapt to this AI technological boom. I'm looking right now, just Gil Luria's call for NVIDIA to be the lowest price or the most attractive shares. Those stocks are up 32% so far this year. So this is the reason why people are getting a little bit nervous. And then you have the likes of people coming in and saying on the relative basis, they're behind. They should be up that much more.
We're concentrating a lot of capital in a handful of names.
Yeah.
That's the risk. That's the risk, but it's paying off at the moment, that's for sure. Nasdaq futures higher by 0.1%. Up next, Stephanie Roth of Wolfe Research on rising rate cut bets. Plus, Danny has your morning movers. RH feeling the effects from tariffs. The open about 60 minutes away. Stocks just about positive on the Nasdaq going into that. On the S&P 500, just a touch negative. With your morning movers, let's cross over to Danny for more. Hey, Danny.
Hey, John, a couple good things going in Microsoft's favor this morning. For one, and perhaps the bigger one, is OpenAI looking at restructuring that would make it appear more like a classic for-profit company. It settles a long dispute between Microsoft and the company, helps Microsoft keep its partnership. Microsoft also settling with the EU and avoiding a hefty fine around allegations around its Teams products, so those shares up about 1 1/3%. Elsewhere, it appears to be a second day of a big rally for Warner Brothers Discovery. Yesterday was their single best day, up some 39%. And this is because the Ellisons are doing a classic media roll-up. Skydance Paramount, backed by the Ellison family, looking at taking over Warner Bros. Discovery, squishing the two together in a company that had been looking at breaking apart, so those shares up 8.5%. Finally, R8 shares getting crushed this morning, down 9% in their earnings. A disappointment there and a cut around tariffs. About $30 million is the charge they will be taking. But the CEO, who likes to use, let's say, colorful language on the earnings call, also saying unless you want to go effing bankrupt, you need to have discounts, something like 30 to 40% on it. I know you gave me permission to say the full quote, but I'm going to pass you on that.
It's Friday. You do you, Danny. Thank you. Looking forward to the show in about 30 minutes' time with Matt Miller and Danny Berger. Open interest just around the corner. I think the RH story is actually pretty important. Home builders have rocketed through August into September, getting excited about rate cuts. You don't hear the excitement about rate cuts from that guy on that call.
Yeah, they don't have pricing power. And this is a question around how much does that indicate true consumer pushback? How much does that indicate a sector-specific issue at a time when everybody renovated during the pandemic and now maybe aren't doing so as much? And how much is this a competitive disadvantage, right? Because some places have that pricing power, other places not so much.
That's the latest on Restoration Hardware. That stock down by close to 10%. Important headline just crossed the Bloomberg terminal. I want to share it with you and give you some details. The US proposing broad G7 sanctions on Russian energy in a renewed bid to end this war.
So basically 100% tariff level when it comes to Russian crude on places on China and India for their purchase of that Russian crude. Also, they're telling G7 countries that they should create a legal pathway to seize Russian assets. Basically a way to try to get Vladimir Putin to the table and end this war. It was a month ago. Secretary Bessent sat around this table and said, it's put up or shut up time for the Europeans. They have for months been trying to get the Europeans to agree to, alongside them, also raise the bar when it comes to penalizing the Russians. And right now they're making a serious push at the G7.
This turns into a game of who's going to do it first and whether the U.S. will follow suit with big tariffs or secondary sanctions, I should say, on the likes of China and India. And this comes as Scott Bessent is poised to meet his counterpart from China over the weekend to talk about what could be setting the stage for a détente or some sort of meeting between Xi Jinping and Donald Trump. A real question here about how this would influence that should this get passed.
Busy few minutes of news here. Want to draw your attention to this too. Forgive me for changing topics quickly. Apple, these headlines just crossing, delaying the iPhone Air launch in China, citing a regulatory issue. Going on to say that the 17, 17 Pro, 17 Pro Max will still go on order in China, but there is a delay. The latest information just crossing, Bramo.
Yeah, questioning around exactly what type of regulatory issue this is and whether Tim Cook, once again, is a part and parcel of this trade dispute between China and the U.S., whether China is targeting Apple for its origin or whether this is something else. We'll get more information, but this really does highlight how much these tech companies are very much intertwined with discussions about trade between the U.S. and China.
Regulatory issue sounds like it is code word for leverage we want to use at the negotiating table, especially given the fact, Lisa, you just mentioned, Treasury Secretary is going into meeting with He Fang. This feels like leverage, and also China reminding their national champions that they want to back them when it comes to consumption of iPhones to their consumers and their economy.
For once, I'll hang back from speculating. All I can say is that the website says the iPhone Air is now coming later. And we'll see how late that iPhone delivery will actually come over in China. Keep an eye on that. The stock a little bit softer in the pre-market at the moment. We're down a few tenths of 1%. Let's turn to the economy ahead of next week's Fed decision. Bloomberg's Michael McKee joins us now for more. Good morning, Mike.
Good morning, John. Well, imagine you are Jay Powell and one of his colleagues on the Open Market Committee, and you've got to decide what to do on Wednesday. You look at the latest economic data, and I'll go back a week and a day, and it isn't particularly good. 2 out of the 3 are not particularly good news for the economy and may suggest a rate cut ahead. Unemployment has gone up since the president took office, and GDP has gone down. The restraining factor is CPI is now rising, and rising relatively quickly. So do you cut rates? And if so, how far do you go? That's going to be the question for Tuesday. And right now, the betting in the markets is we're going to get 25 basis points. The real question is going to be what happens in October and December. Part of that may depend on who's on the Fed. Here's the latest scorecard for that story going on. The Trump administration has asked the U.S. Circuit Court of Appeals in D.C. to rule by Monday on whether Lisa Cook can keep her job as a Fed governor while all this is litigated. District Court judge said yes. Now the Trump administration is asking for an expedited decision on a no basis because they want to keep her out of the meeting next week. Cook's people have filed a response that says you do that Monday night before the meeting and you could get chaos in financial markets, all aside from the fact that it wouldn't be the right thing to do. Then Stephen Myron expected to be confirmed on Monday night, so he would attend the meeting on Tuesday. And the meeting begins at 9 a.m. on Tuesday. So it's going to be a big Tuesday and Wednesday for the Federal Reserve and for the markets, keeping an eye on all these legal matters as well as interest rates.
Mike McKee, thank you, sir. The big breakdown going into the big meeting next week. Sticking with the Fed. Stephanie Roth of Wolfe Research joins us around the table. Stephanie, good morning.
Good morning.
Where's the Stephen Myron dot going to be next week?
I think we might need a new page for that dot.
What kind of changes are you expecting to the SEP?
I don't think there'll be that many changes. I think the Fed will still probably be looking for 2 cuts this year. Little changes from an economic perspective. The real thing is going to be how is Powell going to message the tone? And our expectation is it'll probably be fairly dovish in the sense that we last heard Powell Jackson Hole. He was dovish then. Since then, the data have gotten worse. So our expectation is maybe next week we'll see some dovish sentiment around the Fed. Beyond that, though, we might see strong employment data, at least stronger than what we've seen, and the narrative could easily shift. So we have maybe one more week of this sort of soft, dovish narrative, and then it might certainly turn.
Do you think that he's got to have that in mind when he offers guidance next week? This is the big question for markets. Is this the start of something bigger? A one-off rate cut, a mid-cycle adjustment, or are they going to deliver the big deal? Go all the way down to 3 and think about even getting accommodative.
I think it's a path towards something that's closer to neutral. So call it 100 basis points. Their expectation is certainly not to cut one time and be done with it. Their expectation is they want to cut closer to neutral. They don't feel like they need to be in restrictive territory, just given we have seen a slowdown in the economy. I don't think it's anything that's likely to be cut below what they see as neutral, but just tweak to a level that's not so restrictive, and then they can kind of see from there. So their expectation is to cut a couple times this year, a couple times next year, and then they'll be at a level that they want to stay at.
Cutting to neutral at a time where inflation is still above the 2% target, somewhere around 2.5%. Are we saying that inflation at 2.5% is not a constraining factor for the Federal Reserve in cutting rates to tackle the employment part of their mandate?
So I think right now the focus from them is on the employment side of the mandate, just because payrolls has slowed down so much. Granted, unemployment rate has kind of been okay. It's been fairly steady. I think they're concerned about the direction of travel that we've seen in payrolls. So our expectation is they're certainly emphasizing the employment side of the mandate, at least for this meeting. Beyond that, it's very possible that they're going to have to focus more on the inflation side of the mandate. If we get a September payrolls print that comes in fairly solid and some upward revisions to August, the picture might look quite different.
How wrong are we getting this labor market? And I ask this given the fact that people have talked about immigration, that this is a supply side story more than anything else. It's also at a time where consumers keep spending. They wouldn't be spending so much if they really felt like the world was falling off a cliff. And you still see the unemployment rate hovering at a relatively low level of 4.3%. What are we getting wrong? What are we missing here about whether this is a good or a bad labor market?
I think what we're missing is the emphasis on headline job growth. At the start of the summer, we were talking about, and certainly on this show, that job growth should slow down substantially, the unemployment rate should be largely steady, and wage growth should be fine. That's a signal that it's a supply-side story impacting the labor market. Of course, there's an element of supply and demand, but we think it's more so on the supply side. Looking ahead, there's reasons that the demand side of the economy should pick up. We're going to move past economic uncertainties that ties to tariffs. We're going to have lower easing financial conditions, which should boost growth. Fiscal should start to become a positive. So even though we have slowed down partially from a demand side, that should move in the positive direction, and then we're just left with the supply side, which is just a headwind on regular job growth, but not really a real risk for the job market. It's just telling us that the supply side has slowed down.
I want to pick on a point you made about there's still this concern about inflation and potentially revisions or maybe better payrolls reports upcoming. What does the Fed do then? Do you see a world where they potentially have to hike next year?
No, I don't think they'll have to hike next year. I think they'll be in an environment, the pausing would be kind of the new hike in this sense. So what you would see is an environment where they cut a couple of times, and then they're in an environment where they want to wait and see how the inflation data plays out. And inflation may stay a little above 3% for some time. So it's just enough to be uncomfortable, but not enough to make them change policy in a big way.
Even pausing when we're going to get a new Fed chair?
Well, that's the challenge. So we'll probably see one or two cuts this year, one or two cuts at the beginning of next year, and then they'll have to kind of weigh it out. But the names for the Fed chair, if you have someone like Waller, I think there's such potential that they'll be able to pause and wait it out for a little bit.
Are you struggling to formulate a view post-May next year about what this Fed's going to do? Just how difficult is it as an economist at the moment? Just watching all of this play out down in Washington, a big interview process. Is it difficult to make guesses about what's going to happen after May next year?
So I think what's interesting about this environment is it's hard to have an economic forecast and a Fed forecast that goes together. So in a typical environment, if you give economists a set of same assumptions, they'll have a very direct path in terms of what the Fed's going to do. This time, you can give economists a set of assumptions, and they may have different forecasts for what the Fed's going to do. So it's not just about forecasting the economy, but then it's also forecasting the Fed's framework. And that's what's been so challenging in this environment. So for the economy, our sense is we'll see a labor market that looks just fine, growth that's starting to pick up, inflation that's a little bit elevated. The question is, how is the Fed going to approach that? They want to get towards neutral, but inflation is running above their target. So our sense is they'll cut a couple more times, 100 basis points, and then they'll probably want to stay there, just given that inflation will still be a little bit steep.
And just to be super clear here, you're not confused by what's happening with Washington because of the White House. You're confused because of the reaction function shift of Chairman Powell? Has that been the most confusing element of this?
That's been one of the most confusing elements so far, is just what data they focus on, what should we all focus on to follow the Fed? What are the key elements of the framework? That's been changing throughout the past couple of years, and that's what's been so challenging in terms of following the Fed.
I'll say this for you because you're alluding to it, and I'll make it a little bit more direct. That's a failure of the Federal Reserve and the chairman himself to not be clear about this. And I would go back to the news conference with the Federal Reserve last time around. The chairman anchored his view on the labour market around the unemployment rate. Then the chairman gets to Jackson Hole, one bad payrolls report later, big step down in payrolls, I get it. And his view's now anchored around payrolls, even though unemployment's been pretty steady through summer. So he's completely changed the way he looks at the labour market and what anchors that view. Now, I'm not sitting here saying that one was wrong and the other's right. That's not my position. I'm not in a position to make that point. What I'm saying is just very different what we heard from him in the news conference and what we heard from him in Jackson Hole.
Yeah, the Federal Reserve has changed its stance on a number of things. The reaction function has been more confused just simply because this economy has also been really hard to pinpoint. You get 5 people in a room, they all have different opinions about what's going to happen, and they might change their opinions in 6 months. So I do think you are correct. It has been a failure to communicate the reaction function. A question here is, I would ask this, on Wall Street, do people have a consensus around what the reaction function should be? Or is it just as splintered there because of the confusions of the moment? I mean, I'm not justifying it. I think that this is true in terms of the market's difficulty in understanding this.
A critic of Powell would say that he was protecting himself politically. He opened the door and basically said, look, Mr. President, I opened the door to the Fed cutting. The rest of the committee, it's a deliberative body, needs to walk through it.
Stephanie, it's good to see you. Thanks for dropping by. Thank you
for
very
having
much.
me.
Stephanie Roth there of Wolf Research with the latest. Lots of news breaking in the last 10 minutes or so. Let's get you a wrap of that. Here's Yahara with more. Hey, Yahara.
Exactly, John. And we start with the latest on Charlie Kirk. A suspect in the shooting of the conservative activist is in custody, according to President Trump. Speaking just earlier, Trump said that a minister and the suspect's father were involved in helping to apprehend the suspect, who you can see there in that surveillance video. Kirk was shot and killed on Wednesday during an event at Utah Valley University, which spurred an extensive manhunt. Meanwhile, the U.S. is stepping up its efforts to end Russia's war on Ukraine. According to a proposal seen by Bloomberg, the U.S. will urge its G7 allies to impose tariffs as high as 100% on China and India for their purchases of Russian oil. It will also tell G7 countries they should create a legal pathway to seize immobilized sovereign Russian assets. And another breaking story, Apple is delaying the launch of its new iPhone Air in China. The company's China website would not let customers order the new, thinner device when pre-orders started today. Instead, shoppers got a message saying release information will be updated later. All models will be released after approval. An Apple spokesperson didn't immediately respond to a request for comment. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next, we'll set you up for the day ahead, a sneak peek of next week, and we'll catch up with Krishna Mamani of Lafayette College from New York City. This is Bloomberg.
You have the Fed rate cuts helping those sectors of the economy that are very rate sensitive. What people don't know that today the U.S. economy is not as rate sensitive as it was. It just isn't, because the service sector is much less rate sensitive. But the sectors that are rate sensitive, they're going to be another kicker for the U.S. economy in 26.
Always enjoy catching up with Stephen North of Federated Hermes. Looking forward to a better year in 26. Looking forward to 7,500 on the S&P 500 year-end next year. Equities at the moment on the S&P 500, as we count you down to the opening bell, just a little bit negative. We're down about 0.1%. 41 minutes until the opening bell. Here's your trading diary, 10 a.m. Eastern Time, a little bit later this morning. UMich sentiment Monday, looking ahead to next week. The Senate voting on Stephen Murren's Fed nomination. Tuesday, some more data for you. Retail sales on Wednesday, a Fed rate decision. Plus, the president travelling to the UK on Thursday, another round of jobless claims, and we'll squeeze in a Bank of England interest rate decision as well. That's the week ahead. Let's focus on one decision, the Federal Reserve. Krishna Mamani, the Chief Investment Officer at Lafayette College, writing CPI came in hotter than expected, both core and headline, and it's broadening. That's not something the Fed is going to like. Krishna joins us now for more. Krishna, good morning.
Morning.
Isn't it something the Fed set us up to ignore?
So I think for one meeting, sure. I think in Jackson Hole, basically, Mr. Powell gave the plot away as to what is going to happen in September. The real question is what is going to happen subsequent to September, October, December, next year. And if you look at the employment data, that clearly has softened over. But I think if you look at consumption data, it's kind of hard to reconcile the spending that we see in the economy with respect to and reconcile it with what the employment data is showing. And there may be a lot of buffeting going on because of tariff and kind of delays that ensued after Liberation Day. We'll find out in due time. My suspicion is that it'll be economy is in decent shape, and the real question for the market is to determine whether we are in 95, 98, 2000, or are we in 2001, 2008 from a economy and cutting standpoint.
Do you think then that the yields decline that we've seen in the long end of the yield curve is a head fake?
I think it is recognizing the potential of a softening economy. So not a head fake, but I think misguided would be a better way to phrase it.
So can you walk us through the progression of what you see? Because one thing we've talked about a lot on this show is whether the Fed is cutting into a reacceleration or whether Fed cuts are going to ignite that reacceleration of growth. And it matters for inflation. It matters for the nature of this rally or not. How do you see things?
Well, so I think if the Fed cuts and it reignites the economy, there has to be a sufficient amount of lag relative to that for things to work through a very large economy. So I don't think if they cut, that would be the cause of reacceleration. If it reaccelerates, it will be because the economy was not that soft to begin with, and they cut because of all sorts of reasons. And, you know, if you go back and look at last year, we were not too different from at the same point last year as well.
Do you think the same thing's going to happen in terms of long-term yields?
I suspect that is what is going to happen as well.
When it comes to the inflation story, are you concerned about some of the components we saw yesterday with sharp acceleration going up?
Well, so again, if you look at the data flow, the acceleration can be reckoned. You know, it's what is causing the acceleration. You know, goods or services, and that sort of gives you a little bit of clue. So the data headline number was hot. The core numbers were hot, but they are not totally out of the context of the Fed kind of trending lower with kind of keeping an eye on what's going on in the real economy.
So if the Fed cuts, we have a repeat of last year, what do they do about the long end of the yield curve that's attached to mortgage rates?
Well, so I think that's really the question. But, you know, we are singularly focused on the Fed, what the Fed is going to do. However, the Fed can continue to cut. And if the economy reaccelerates, the bond market is not going to kind of take it very lightly. And the long end of the market is probably going to sell off, and the curves are going to steepen. And therefore, you may not get the oomph in the cyclical part of the economy that you may be expecting out of Fed cuts. So, yeah, the Trump administration may control the Fed, but the likelihood that they will move the economy in a meaningful way because of rate cuts, I think, is up in the air.
We've known each other a long time, and periodically I've come to you around turning points to try and get your view of the world. And I remember going back a long time, and you've got a decent record of doing this. I don't. I struggle with it for obvious reasons. It's hard. You said it's either the mid-90s or 2001, 2008. They're two very different environments.
Absolutely.
What's guiding you to make that decision if it's one and not the other?
Well, so I think you have to look at the fiscal impulse in the economy. You know, deficit spending. Is it low or is it contracting? The answer is no. Do you think there are technological innovations that are taking place that may drive investments and things like that? The answer is yes. So in that context, it looks more like 95, 98 than it looks like 2001, 2008, when we were heading into a dislocated kind of agents in the economy and delevering that ensued. I don't think that is the case this time around.
So buy stocks and not bonds?
Yes, I think bonds are. I think bonds are in a range, in my judgment. You know, 3.5 to, let's say, slightly above 4.5. When they get there, you buy bonds, and when they get closer to 4, you sell. Stocks, on the other hand, you know, nominal instruments. We have decent nominal growth, and it may accelerate, and so they probably keep up. I think they do just fine.
What's the risk-free asset then?
Well, that's an interesting question. I think the risk-free asset at the moment is really cash, for that matter. You know, that's the only thing that, you know, it's not bonds. You know, bonds would be a riskier free asset, if you will, at 4.5, 4.75 over 10 years, as opposed to at 4%, given what the inflation picture and what the growth outlook is.
Krishna, You've given us a lot to think about. We appreciate it. Going into the weekend. Thank you, sir.
Thank you.
Thanks for being here. Christian Mamani there of Lafayette College. Stocks over bonds is the mid-90s. It's not the end of this.
This is really the theme that I'm hearing from everybody this morning, that if you believe in inflation running a bit hotter than it has been in the past, you believe in this sort of reacceleration, well, bonds aren't going to offer it to you. Even dividend-paying stocks, probably a better upside hedge to any kind of growth than bonds.
Is there a risk-free asset in the world of Trump where we are reshaping the geopolitical and economic landscape around the world?
So far, it's gold.
Yes. Yeah,
at least
gold,
so
that's
far
it.
this year. It's not the traditional bond market. Coming up on Monday, as we count you down to a big week next week, we'll be catching up with Laurie Calvasina of RBC, Christian Nolting of Deutsche Bank, Henrietta Trace of Veda Partners, Greg Peters of PGIM, counting you down to a Fed decision, statement, forecast, news conference, all of that coming next Wednesday. From New York City this morning, good morning to you all. Have a wonderful weekend with your loved ones. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.